Hit it.
It's September 18th, 2020, episode 97. I'm Patrick Ceresna.
And I'm Kevin Muir. This week's first guest is SpotGamma's Brent Kochuba. We have a terrific discussion where we dig into the SoftBank whale strategy and talk about the ramifications of the increased popularity of options. Then we talk grains with the one and only goddess of grains, Angie Setzer.
Then in This Week in Trading History, we revisit the Lehman bankruptcy for the WTF Clip of the Week. The market is on cocaine. We then do our new segments of No Stupid Questions and Skin in the Game. And Kevin, we might even drink some beers along the way. So folks, stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So today we're drinking Brimstone Brewing Company's Sinister Minister IPA. It's a strong beer, 7% alcohol. Unfiltered and generously hopped, Sinister Minister pours a vibrant orange with a malty backbone to the hops. Dry hopped to further accent the bright citrus, floral, and stone fruit aroma, aided by a hint of resinous pine. I think I already know how Kevin feels about this one.
Amen.
Well, you know what? It's kind of the picture freaked me out a little to have a minister with so many tats on his hands.
It's delish. I'm looking forward to this. I'm gonna enjoy it. Anyway, yeah, Kev, why don't you give us a quick disclaimer?
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include battery bed sores, gamma flips, and TikTok ticks.
All right, Kev, let's get on to our first guest.
Okay, we welcome back to the show Brent Kochuba from SpotGamma. First of all, Brent, before we start, I just want to say I've been reading your stuff since you came on our show, and I guess it was episode 63, January 18th of 2020. And for those that didn't catch that show, we highly recommend you go and spend some time and learn, what Brent was talking about in terms of gamma and all of the hedging that all the different dealers have to do. But Brent, I've been reading your stuff since you came on the show, and I must say, I've been hugely impressed. It's been terrific stuff. It's becoming more and more important, and I highly recommend your product.
Thank you very, very much. I appreciate that.
Yeah, it's been some great stuff, and given the developments of the market recently, and the fact that more and more people are using options, whether it be the Robinhooders, the SoftBanks, or the PIMCOs of the Bridgewaters of the world. We're getting more and more options, and your product is becoming more and more important because it's becoming a situation where the tail is actually wagging the dog.
Yeah, it seems like it, and it's been an unbelievable week, really. For SpotGamma and just sort of that gamma theory in general. Just everybody loves a villain, and I think SoftBank just decided to unfortunately grab some headlines and that really drew people's attention. It's on the front cover of every paper and all the news shows and everything like that. And so it's, it's been great exposure for us. And it also sort of vindicates, a lot of what we've been talking about.
Right. So let's jump into it. And, you mentioned SoftBank, and why don't you walk us through what SoftBank did and why everyone got in arms about it?
Sure. So much of what we thought was driving the market up, obviously you have the fundamental drivers of, the Fed backstopping the economy and expectations and all those sort of macro views, which you specialize in more than I do. But I think the velocity of the return was based on obviously long call positions. And that story's been out there. And if you just sort of look at, the metrics of record long, small trader, long call positions and the like, that story or that piece of the story I think has been told and people understand that. And what was so interesting about this is that it was very hard to time, the top and it was one of the frustrating things for us in our daily reports was we talked about the potential for the unwind and the instability of the market because of these large call positions. And so what happened really is if you sort of look at a chart, which we have here on this slide, it's just a chart of the S&P with the FANG stocks. And, COVID just looks like the COVID crash looks like a little blip, even though it was a 25% drawdown in the market, those FANG stocks have basically doubled since then. But the gamma unwind that took place just over a few days in March is almost as large as that COVID crash. I mean, it's really pretty remarkable how quickly, that mechanism broke. And so what happened with SoftBank was that it came out that they had put on a bunch of large call positions. And, everyone is quick to sort of assign gamma nowadays with basically every move that exists. And so everyone had basically said, it wasn't retail, it was SoftBank. They were the reason that the market really took off into August and for, that really convex move higher. And, we have some data here and some statistics, to show that really wasn't the case. And so what was interesting kind of about this unwind is that the news came out about SoftBank at the same time that a couple other metrics happened. So, it's a little bit hard to say what was the trigger to sort of get this thing to sort of drop in the gamma position to unwind, whether it was a SoftBank headline or, Tesla not making the S&P or, a myriad of other things. The same mechanism that drove the market up really kind of reversed on itself, and unfortunately, SoftBank was ascribed the blame for that.
Right. Like, so let's just jump ahead to slide 5 here while we're talking about SoftBank.
Sure.
And you said the title of your slide is "No, SoftBank didn't weaponize gamma."
Right.
And
right.
this is actually something that your narrative is different than what the story that many others are telling. Why don't you walk us through your opinion about what SoftBank was doing with their trades?
Definitely. So I view it as a stock replacement trade is what they did. And the reason for that is there is a bunch of data, and I don't know if you all are familiar with Ben Eifert. I think he maybe even been on the show, that he had also mentioned that the news from Flowdesk was the same, that these were actually spread trades and not outright positions. So if they were outright positions, it means that SoftBank essentially was long calls with no cap sort of, or no hedge to the upside, which meant that dealers had sort of unlimited risk to the upside. Now obviously they would hedge themselves out, but just on the face of it, SoftBank would have unlimited upside exposure. But in this case, there's a lot of evidence that suggests that these were actually all spreads. And what that means is that, they had a limited amount of exposure to the upside. And it looks like a lot of these positions were tied to stock, which means that they likely added calls or call spreads and tied that to stock. So it was a delta neutral trade, which didn't probably bring much of a hedge for dealers because, again, those call spreads were tied to stock. And that probably meant that SoftBank was lightening up on a lot of their tech exposure in this case. And so in this slide, I'm sorry, go ahead.
Oh, no, I didn't mean to interrupt. I'm sorry. Well, let's just go through an example so people understand, and let's go just break it down. When we say a call spread, let's just take this first one, whereas the Microsoft November 220, 240 call spread that he bought. Why don't you walk us through what he paid and how it worked, and just kind of imagine we're SoftBank buying this from a big dealer. Right. What would be the mechanism that would occur?
Right. So, in this case, SoftBank would contract with the dealer. They would call them up on the phone and say, we want to put these call spreads on and basically make us a market. And these were big trades. So, I'm sure it didn't take just one phone call, but basically SoftBank would say, hey, we're looking at these call spreads, or we're looking at lightening up on exposure in our Microsoft position. How might we do that? And whatever the case would be, they would narrow it down to, okay, this is the trade we want to do, which is the call spread. And so they're long the 220 call. Right. And to fund that or to cap their risk or make the trade cheaper, they would sell the 240 call, right? So they essentially have 20 points of exposure there, right? 220 to 240 is the call spread. Right. And in this case, so they did that 75,000 times. So they owned 75,000 call spreads in Microsoft, and they paid $6.90 for that. And so they, at the same time, according to this data from RBC, did that neutral, which meant that the dealers calculated what the delta of that spread was, and said, okay, we're also going to sell X amount of stock at $213. And therefore it's called a delta neutral package, which means that at the moment the dealer agrees to that trade and they accept the risk, they're hedged out at that moment, right? Now, if the stock moves around, they need to adjust that delta hedge, but essentially there shouldn't be any market impact from that trade. Now, had SoftBank simply went out there and started sweeping electronically Microsoft 220 calls, and not spreads, but just 220 calls, you would have had the whole street scrambling to buy Microsoft stock because, the whale, so to speak, is out there just, taking advantage of everybody and sort of running them over with outright call orders. So how they put the position on infers, much less of a market impact than a lot of the headlines would suggest.
Right. So to me, there's two big takeaways from that. First of all, the fact that it's delta neutral kind of leans credence to your theory that this isn't what was driving the market higher. And then second of all, the fact that they were selling some upside calls, making call spreads, means that the dealers were not short gamma through the entire portion of the curve, right?
Exactly.
As it actually went higher, it was kind of more the traditional situation where they actually ended up being long gamma again, right? Or at least the short gamma ended up going away.
That's exactly right. So you hit a dead on there. The upside, the convexity to the upside was capped off, by that short spread the short leg of the spread at 240. And likely what I believe, happened was that the stock they sold against this spread was stock that they were long, right? It was well known, I think, that they were long, a whole slew of tech names just owned the stock in those tech names. So likely the stock that was sold was stock they already owned. So that's why I feel like it's most likely a replacement trade where we say, okay, we're going to take some off the book, take some stock off the book, and leave a little bit of upside here in the form of this call spread. But we're essentially, unwinding, our long Microsoft position.
So, Brent, I'll play devil's advocate and give you an alternative theory that might explain the stock movements a little bit more.
Please.
What if he actually was buying the stock in the marketplace to, like the day before or the day of, and the morning of, to actually give the dealer the delta?
Yep.
And then what if he was using call options because he was levering it up? Or sorry, what would if he was using call spreads because he was levering it up and wanted to do all the more? Meaning that he wanted to really, juice this thing to get even more leverage. And what about the fact that a dealer, even, the big Goldman Sachs and JP Morgans, would they sell 75,000 outright? Like, I don't know. And I guess that's my next question. Are we hitting into levels where the dealers can no longer, the option trades are so big they can't take the other side?
Yeah, listen. Your theory is a good one, and unfortunately, I'm not on a flow desk at a bank, and I think some of those guys probably listen to the show and maybe are shaking their head at what my sort of thesis is here. But I would suggest that is a lot of risk for them to try to jam the stock and then do call spreads the next day. For a fund that is as big as SoftBank. If it was a smaller guy who was a little more nimble, I would maybe buy inside a little bit more. But I also think that, I think it was well known they were long these stock positions if you look at the filings in the SEC.
Okay.
And so
just explain to people why you think this is a bearish strategy. Just explain the why this could be interpreted as them actually lightening up as opposed to adding to the positions.
Simply because you're replacing long stock, which has a 100 delta, right, or a 1 delta, however some people may want to say it, which means that for every dollar stock goes up, you make $1 per share, right? And the call spreads don't have that same profile, right? You're right. Long, I don't know what that delta on that spread would be, but let's say 30 cents per dollar if the stock goes up, and your risk is capped, right? If the market turns and goes down, then your long stock position is losing dollar for dollar. But that 220, 240 Microsoft call spread, you paid $6.90 for that. The loss on that, should the market turn, is a lot less.
Right. So you mentioned Ben Eifert. He was busy, explaining to everyone that he thought that this rally was actually more the work of the Robin Hooders because the amount of call options that are trading in terms of just outright retail and hedge funds and those things is through the roof. Now, one of the kind of strange dynamics that has occurred because of all these call options that are buying is the fact that calls and volatility has been rising as the stock market rise.
Yes.
And I just actually like to read, something from your great letter here. And this is a quote from your letter. And it says, "We've had a few inquiries last night about what might break the call gamma cycle down. While an unknown event is an obvious one, I think there is some point at which the dealers can't hold more inventory. For extreme moves, the only way to hedge options is with options. This is because options have convex return profiles, whereas stock is linear. Because of this, dealers must own options at the tails to protect themselves. When dealers own those options, their hedging profile changes such that they become sellers as those stocks go higher. Watching to see when implied volatility tops out in single stocks may be a key in detecting this dealer shift. Why don't you explain that to us?
Sure. So the idea there is that if you are trying to hedge out a option position as a dealer or a market maker, you generally can hedge out pretty effectively small moves with stock, right? If the stock goes up a buck, you buy or sell a few shares here and there, and your risk is more or less covered. But when you start to get these 2 or 3, 4 standard deviation moves, the options are moving in a relation, they're moving in a convex way, whereas the stock is moving in a linear way, meaning that if this stock moves up 10%, you know exactly how much your stock price has changed, right? But your option is going to move a multiple of that move, right? And so what that means is essentially that if I am hedged out at this moment at this price in stock, and the stock goes down 10%, there's not enough shares that I could buy to keep up with the convexity of the option return. And so when we talk about, the convexity or the tail risk, the dealers need to hedge themselves such that when they go home at night and the risk manager looks at their books, they believe that their tails are covered, right? That they are not exposed to a very large, 2, 3, 4 standard deviation move in the underlying. And so, for those big moves, you can't buy or sell enough stock to keep up with the change in volatility or the change in applied volatility of the options and the convexity of the options. And so that is why at some point, I believe, dealers were long calls, or they had changed the implied volatility market so much that the call payouts were never going to happen, right? In other words, if I was going to buy a Tesla call that expired in 3 days and I was going to pay $100 for that call, it was never going to give me a positive return regardless of what, Tesla stock did. And so by either owning calls themselves as dealers, to change that profile, and or, really increasing implied volatility, the cost of calls, they're able to sort of defend themselves or change their own risk profile, if that explains or makes sense.
Right. And was there a certain extent the dealers also going into different squares, meaning if you're short, let's say the FANG stocks, you're short, Facebook, Amazon, Netflix, Google, and you could go buy QQQ volatility because something is better than nothing in terms of getting some. So is that what we were seeing when we hit that point right before the market crashed in terms of in these names? We saw implied volatility on the indexes going up with the stock market. Is that what we were seeing?
Yeah, I think a lot of that was bleeding into that high call implied volatility, through various different arbitrage mechanisms and the like, does bleed into the index volatility space. I also think, because you have the election coming up, that's doing some funky stuff to, volatility levels, out in time a little bit and holding that up. And so I do believe that it was sort of this call movement that was sort of making its way through the back channel, sort of back in from individual calls on individual stocks into, the VIX or the larger volatility complex.
Right.
And, I do think that, yes, there is a lot of times where I'm going to hedge my FANG portfolio with Qs, but, you look at a move in Tesla or even an Apple, and, those moves or Salesforce or Zoom, those things are moving so much that even if you're hedging with, Qs or something like that, you're still exposed to so much risk because there was such, difference in individual name profiles when I talk about, the gamma profiles of individual names.
Right. Now, when you first started this presentation, you showed us the COVID crash, and now you called it I guess we could call it the SoftBank gamma unwind. One of the things that you've been kind of pointing out to readers and of your letter is the fact that PIMCO had done this in March, and this was a repeat of March. Why don't you walk us? Sorry.
That's all right.
Yeah, Bridgewater. I mix them up, the big behemoths all the time. Bridgewater. Why don't you walk us through what it is there?
Yeah. So first, I want to state, this is obviously just my theory. There's guys on Flowdesk who know this, and I don't think that Bridgewater is trying to do anything nefarious with this. with this position. But it sort of leads to my sort of overall point of the discussion, which I think we get to later. But if everybody remembers, I mean, it was headline news that Bridgewater made a $1.5 billion options bet, buying puts. And Ray Dalio is out there saying, look, we're not going against America. We don't think that things are going to crash. We're hedging ourselves basically. And I, for whatever reason, had, been going about my work every day. And about, a few weeks ago, it suddenly dawned on me to actually look up those positions in relation to the COVID crash, so to speak, in February. And it's really fascinating because you can see the huge March options positions, put positions. And I talked about those every day, from February into March, and how big these were and the delta implications of them. But it never clicked in my mind for whatever reason that this was related to these, possibly related to these Bridgewater positions. So we have this slide here, which shows that, and this is really fascinating to me, because if you all remember back to February, it was not long after we had originally talked, that there was a similar situation in this record long retail call position, right? And everyone was long calls and the market kept going up and up and up. And it was a very similar, story or narrative out there about, record small traders and the like in calls. And February had a very full book of positions, meaning call positions. We blew through those numbers, in the last few months, but still at the time it was just kind of unbelievable. And we're all looking around saying, when and how is this going to end? Right. And so what is so interesting about this is in February, if you look at the data that I provide on this table, I believe it's from February 12th was the date that these positions were on the books as open interest. Just to read the first few lines of size, and this is just for the March expiration. So in the 3,000 puts, and this was in the S&P, was around 3,400. So in the 3,000 puts, there was 93,000 3,000 puts. There was 91,000 2,000 puts. There was 70,000 3225 puts. And, you can keep going down the line. I mean, there's another 20 strikes here that had well over 25, 35, 40, 50,000 puts in them. So huge size, right? In all those positions. And this was in mid-February when the market was just humming along and people were loving calls. And so what happened in February? Well, we had an expiration on the third Friday of February. All those record long calls expired. And then there was some bad news, right? COVID kind of broke that weekend in China and some other things like that. And that caused the market to kind of go down. And what I think is so fascinating about this is that those huge put positions require delta hedging by dealers, right? And they need to hedge themselves by selling futures. And those are huge put positions. And so every time the market goes down, they need to keep selling. And it's a self-reinforcing cycle, right? The cycle just repeats itself. Market down, people panic, buy more puts, more bad news, short futures. It just is this reflexive move lower. And what the other interesting moment is that the low in the S&P was the Monday after the March expiration, which meant that all those March puts expired, as you can see in the chart there. The low the next day is the Monday. The next day is when the S&P bottoms out, and we've returned, I don't know, what is it, 4,000% in the S&P since then, or whatever it is. So the way that those things line up are just really kind of shocking to me. And again, I don't think Bridgewater did anything nefarious there, right? But the fact of the matter is when they put on these put positions, right, they're forcing a hedging obligation on a counterparty, and the puts were a hedge for their own book, right, for Bridgewater's own book. So who knows what they're doing? But the point is, the dealers now have these large positions which must be hedged. And so, forgive me for talking. Please tell me to pause for a moment. But what I want to tie this back into is the SoftBank thing, right? There was the put positions right now, at least from my seat, they're nowhere near that size. And so what's fascinating here is we have another third Friday of expiration, coming up in quad witching here in 2 days, and we had record, call positions, and those positions have been squashed a lot. But why didn't this call unwind or gamma unwind from SoftBank not catch fire, right, and expand into something bigger? Well, I just don't think there was very big put positions. There was not the same, impetus from people to want to short and hedge and kind of let that other piece catch. So really what happened on the gamma unwind was, in my view, all these dealers, had long stock positions to hedge out short calls. And once those long call hedges are sold out, they're done, and the move sort of expires, and the move just, now we're just sort of range bound, right?
Right.
So I think it's a fascinating juxtaposition there between those two moments in time where the initial sell-off was the same catalyst, I could argue, but one really caught and the other one didn't.
So, Brent, this is Patrick here. First of all, I just want to let our listeners know that we're recording this on Wednesday. So we're just we don't know what happens here on Thursday, Friday before everyone listens to the show. But I wanted to just touch about this gamma flip. Like right now, where's the gamma pin right now going into Friday at the time when we're recording?
Right. So 3,400 is where the largest concentration of gamma sits in the S&P that expires on Friday. And we also see a bunch at 3,350. And so our gamma flip position technically comes in just above there. 3,380, I believe, is what the flip level is, meaning where we go from a positive gamma scenario to negative. But we're really watching 3,350 as a level that has to break. And so typically the statistics show that volatility into the Friday expiration is actually pretty quiet. There's not a lot of movement as we get closer and closer, and the market kind of pins these high open interest ranges. And so, the next 2 days, our forecast, and we've told our subscribers this, is we're going to kind of stick in this 3,400, 3,350 area due to the size of the open interest there. And then what happens is on Friday, all these positions expire in the S&P, in single stock, in futures, it's the quad witch, obviously. And so what that is a loosening up sort of the straitjacket, so to speak, of the market. And we look for a sort of a break in the market one way or the other, starting next week. So yeah, if you look for this chart from Pat Hennessy, is a really smart guy. It shows that, as we move into OPEX, the volatility constricts, and then the week after expiration, which is the far right bar there in the chart, you get a real expansion in realized volatility, after that third Friday expiration.
Right. And so basically, if beyond the Fed reaction that we're getting here, on balance of probabilities, obviously we don't know how it plays out at the time of recording. Odds are that the market's going to pin and the volatility will start to return in the markets next week. Now, you here have another chart showing how this is going to develop here off the 3,800 stocks and ETFs in here. What are we looking at?
Yeah, so we have this tool called the Equity Hub, which allows us to analyze all the gamma positions and option positions and all these different names. And if actually, Kevin, if you could flip, there's a Tesla chart there, which may be a little bit easier to talk about in this scenario. I wanted to show you guys sort of the difference in the change in gamma. That's it. Thank you very much. The change in gamma position between late August and early September. And so what you're looking at here on the chart on the left is the blue line is the amount of gamma, call gamma in the market, which our model shows. And so the farther that blue line goes lower, which is essentially more negative gamma, the more dealers have to hedge, right? So as the stock moves higher, in this case, it was moving towards 2,500 Tesla pre-split. Dealers had to keep buying more and more and more stock, right? And people kept buying more and more calls, which meant dealers had to buy more and more stock, right? It was this reflexive move again. And so you can see just how large that gap is between call gamma and put gamma. We look at it as, a several $100 million difference in hedging requirement, for every 1% move higher, basically in Tesla. And so you could see that was the setup, and that was an inference of the volatility or the hedging requirement by dealers in late August. And then the chart on the right is after this gamma unwind, it's a completely different animal, right? Those calls had all expired at the end of August. The stock had sold off very sharply, and actually put gamma kind of dominated in the name, but overall that gamma had really decompressed. And so if you check out the notional value limits between the two charts, you can see that there's a sharp difference, a sharp drop in overall gamma, but also the call, people had decided that they no longer wanted calls. Now, obviously this is after, Tesla wanted to do the $5 billion sale, and then they didn't make the S&P 500 on that date and that kind of thing. But it shows the extreme difference, at the end of August when it was a very hot call buying frenzy versus suddenly nobody wanted to touch Tesla calls, and and then today actually that people are back into buying calls over the last several days.
Or are they? So that was going to ask you that, Brent. It's Patrick here again. So like, have you seen that the nature of what they're doing has returned? Like, because we see that like a lot of the other names, Apple, Facebook, Google, you name it, they are still trading at their weak lows. They've been very weak all week, but Tesla snapped back pretty violently on the upside. Very different characteristic versus the other FANGs.
Yes, there was. Oh, I'm sorry. Go ahead.
Yeah, no. I was going to ask you if you felt that the way that these options traders are positioning themselves has contributed to that.
100%, and I think it was people front running battery days is all I can guess. There was just really big order sweeps all week. And so, obviously the stock had unbelievable move up higher. I think it's up, 20 or 30% for the week here. And so you could see that it's the current chart that we have in our equity hub tool is not the same chart that you see there on the left, but it looks more like that than so to speak on the right, where you have put gamma is a greater notional value than the call gamma. And so, people are back into that name and they're back trying to force things higher. I looked at the volume today in Tesla and I looked at it at 130, and the 500 strike calls, which are $50 above where the stock is trading at this moment. So that's over 10% higher. These calls expired on Friday. They traded over 60,000 contracts.
Wow.
At the time I had looked, and again, that was around 1:30 or 2 o'clock. Stocks at 445, 450, open interest at that strike 4 Fridays at 30K. So, that's 60K calls that are trading today in the name. I mean, it's pretty staggering to me.
Brent, sorry, it's Kev here. Just a quick question for you. You mentioned order sweep, and for those who don't know, why don't you explain what an order sweep is?
Definitely. So I'd like to talk about sort of the difference in impact. But when I sweep an order, there's a couple of different electronic trading mechanisms that can work, and so I'm gonna pretend that I'm a hedge fund sweeping an order and not putting an order into Robinhood, because I think the two work differently. So if I'm a hedge fund and I'm using an electronic sweeping algorithm from a bank, right, from a Credit Suisse or somebody like that, I say, okay, I want to buy 500 contracts, and they have a mechanism that will go out to all the different options exchanges and sweep the book at the price that I'd like, right, on the bid or offer or however I want to do it. And the interesting thing that when I sweep the market like that, the counterparty doesn't know what's coming, right? They're sitting out there electronically on the bid or offer as well. And, when they trade, they go, okay, I got to hedge that out. And generally those trades aren't really that big. I think most of the time, big orders are done via the phone still, or done, with the dealer as a counterpart, and you kind of work together on the trade. But if I electronically start sweeping up a lot of orders, I'm forcing dealers and market makers to hedge, right? Because they don't know how much more is coming, right? You're kind of in the dark. And so if you are really big or retail works in a group to sort of start buying a ton of calls via their brokerage systems, it's the same mechanism that all of a sudden the risk is just being poured onto the counterparties, meaning the dealers or electronic market makers, and they have no choice but to really start reacting and hedging that out. Small trades, a 5 lot or a 10 lot or something like that, no big deal. It goes into the book and nothing really happens, right? But if you start talking about thousands of positions, or that can change the hedging demand, so to speak, for the stock.
Right. So that's changing the nature of how we've traded options in the past, because in my day, the SoftBank type of gentlemanly phone up and trade against stock, and or at the very least, even if you didn't have the stock, it was always you would do it against a certain level and you'd wait till the stock got there. That was how it was done. And now with the sweeping, it's a much different environment. And one of the things that I just wanted to chat with you is I'm going to do another quote that you wrote in your recent letter. It was like, on a separate note, we wanted to make mention of the attention that gamma has garnered, especially in the last week. I think there's fairly tight community aware of the mechanism helping to drive markets up into August, but the very quick unwind and SoftBank coverage has brought about a real spotlight to this study. With this likely comes a change in perception on how options can be used. and this may lead to market makers having to add some defense mechanisms. It has long been etiquette, for a lack of a better term, that a buy-side trader would not use their order to run over their dealer counterparty. It's easy to imagine there are order initiators with this new leverage mechanism who don't care about being polite. And you mentioned that you're going to expand on this in the coming weeks. Why don't we chat a little bit about that today? What do you think?
I would love to. So I would like to sort of, I mean, most of your listeners are probably familiar with how the process typically works, but I used to work at a bank desk, and I had a few uncomfortable conversations with clients who would do something like, let's say that, Kevin, you're working at the bank desk there, right? And I call you up and I say, hey, Kevin, I want to buy 1,000 Microsoft calls. And you say, great. And you give me a two-sided market. And I tell you, I want to buy those calls, right? And, you're able to get in front of the position. You can maybe hedge a little bit or look in your book or decide, what you want to do with this position to lay off your risk, right? That's how normally, I think these things work. Now, there was conversations that would obviously happen. I'm sure they're happening every day across the street, where I would say, hey, Kevin, where can I do 1,000 calls? And you would say, $1. And I said, great. And I would buy those calls from you. And then I would go onto my electronic trading mechanism and I would then buy 5,000 calls. And what would happen is you and your 1,000 calls will get run over. Right. And there's ways of, obviously the dealers know who's doing what or can surmise who's doing what. And, if that happens oftentimes, or if you think someone did it maliciously, you call them up and say, look, I am providing, risk capital for you. I'm facilitating your order, and you just ran me over and cost me a ton of money. And, and then typically there's a lot of swearing and that kind of thing, and phone slamming. And so, that is historically what would happen. And in general, that's not, okay, as a dealer, you get a slap on the wrist. And if someone is always a jerk, you just don't deal with them anymore, or you widen your market out, $10 wide or whatever you want to do, and move along with it. And so what I think is fascinating about this, and, I've thought about this for a while, is that if you look at that Bridgewater situation, or what I think happened there, with those huge in the money positions, or what SoftBank was blamed or, may or may not have done with these, the call gamma whale, I think that people are going to start changing the way they trade from, hey, what is sort of my gamma on this trade, and looking at my risk, in a risk system like a Bloomberg or whatever, to saying, hey, what size do I have to do to make the dealers do X or Y, right? I'm going to buy 1,000 calls here and sort of corner the market or force the market to do something. I can use this leverage to make somebody else react in a certain way. And so, if you go into like a Reddit, the Wall Street Bets guys are all talking about buying calls, and they start to catch wind of this, right? And they're sort of in a way doing this, right? They're all electronically sweeping Tesla calls all day long, and they're paying whatever price shows up on the screen. They don't care because the stock always goes up. And it's sort of the same mechanism, right? Now, obviously, they're not working together, at least in actually the way that they're acting. And they can't call a dealer on the phone and trade it any other way, but the force is the same, right? They're all acting together. The retail herd is the same way, and they're doing the same thing, right? But I've always wondered, and I've felt like there's times in the market where, man, if someone just swept 25,000 S&P puts right here, this thing could really fall apart, quite quickly, right? And you look at the risk in your book of saying, like, okay, if the market goes down 1%, my puts are going to return whatever 10% or something like that. My delta on these is a 10, and here's how much I'll make. But I don't think people consider it or have thought of before of like, oh, I'm going to buy these, and that means the dealers have to sell, 1,000 futures, and that's going to drop the market 10%, and then I can cover. And so that is sort of, I think, the exposure, or the light this is sort of shed on the SoftBank situation is really shed on, the study of gamma here, and that, obviously guys at banks and people in the space understand what I'm getting at, and probably it's not a real revelation to them. But I think there's people who, who have size and want to trade, who, this may shed some light, right? I mean,
yeah,
I don't know what a foreign government or somebody else. I mean, you could go down a conspiracy tunnel here, or a rabbit hole, so to speak, with, what forces you could, kind of exert on somebody, or, a market or a stock this way. But, this certainly, I think, has exposed that idea or that concept to a lot more people.
Well, that's some terrific insights, Brent. So listen, I'm looking at your these kind of, what do you call this? The spot gamma kind of position chart that you have. Let's go to the last slide, Patrick. And let's just show people again what it is. So you analyze over 3,800 stocks and ETFs. I just get your letter. I don't actually go on your website. Is it available on each and every one of these stocks, or is it just?
Yeah, that's right. Sorry, I've been cutting you guys off all day.
No worries,
here.
no problem. It's one of those problems when you don't have video. Okay.
So if you go to our website, we built this tool and it analyzes, again, 3,800 different stocks and ETFs. So you put in Apple or Google or whatever you want, and we show you this. We call it the options map, but it's basically the profile, the options profile for each and every stock. And from this, you can see where the volatility sits and where the big hedging levels are in each name. And it was a fascinating thing to watch because you could see these call gaps or whatever you want to call them, call gamma building and all of these different names. And it was an interesting trading tool because, as you guys know, you run a fantastic site for people who are, analyzing the market and setting up different trades. And through your coaching, you can understand that, you want to catch the volatility wave when it's ready. And we think that this tool does a great job of exposing, which stocks are positioned the right way for volatility and which stocks are going to be pinned down by options, and just how that picture is changing. And I think it's obviously very relevant. We're kind of lucky the market has gone sort of, gamma wild, so to speak, here the last few weeks. But this options mechanism is clearly growing, and I think that a lot more people are looking at it as a way to get exposure to the market over simply buying or selling shares.
So, Brent, I had no idea. So I've learned something today, too. I'm going to go check it out. For those who want to learn more, why don't you tell them the website, just kind of drill it in one last time and tell people where they can find you on Twitter.
Great. I'm at Spot Gamma on Twitter. You can reach us spotgamma.com. That's spotgamma.com. There's contact boxes in there if you want to send us an email. And we'd love to hear from you. And we're very appreciative of the opportunity to talk to you guys again.
Terrific.
Well, thank you so much, Brent.
Yeah, thanks for coming on.
Appreciate it.
Cheers.
Thanks, guys.
Okay, Patrick, it's my favorite time, talking charts. What do you have in store for us this week?
We have lots in store for it because what a crazy week in the markets, and so much is just happening, right? We have to just quickly start off right off at the top and just look at what happened in the S&P 500. We'll talk about that September contract a little bit later in the show, but we certainly had a market that tried to rally and has been very weak. And now that we've got this gamma roll-off, now we obviously talked about it with Brent just now, it'll be really interesting to see whether or not the big volatility comes in. And more importantly, will there be one more fake out to the upside? I still think that there's more selling to be had here in the markets. I would not be surprised if this became one of these like 15 to 20% moves and we're revisiting the summer lows on the downside near 3,000. What do you think of that idea?
I don't know. You and your 15 to 20%. What does that make? How much does that take us down?
3,000. That's that. A move to the
is 6. Oh, from the highs. Okay.
Yeah, from the highs, a 17% pullback would be basically the 3,000 level, and that's just the summer lows. I think that's incredibly reasonable to expect. I mean, the thing that we really should be talking about is the impact that the Nasdaq is having on all this. So while the S&P 500 is made up of 500 companies, the 5 FANG stocks, the big boys, actually make up 20% of the index. In other words, the 495 other stocks make up the other 80%. And so even though I've heard the argument quite extensively that there's going to be just sector rotation, everyone's going to come out of this momentum and growth and these technology names, and we're going to go into cyclicals, value, and all these other things. But when we're talking about the impact on the index, how does the index in any way stay higher when 20% of it is composed of those 5 stocks?
Well, one thing you could think about, Patrick, is that just because the index is headed lower doesn't mean that you need to own all the stocks. And I always say that the equal weight, the RSP, which is the S&P 500 equal weight index, is a great alternative.
Yeah, well, that's already shown its worth already. Like, it's been holding up far better. And probably will have less downside than the broader index.
Right, because you say it's broader, but it's not really broader.
Well,
the reality is that it's actually
market cap
more
weighted. Thank you for
That's
correcting
right,
me.
yeah.
It's,
No problem, but and when you think about that market cap, you're absolutely right. Those top 5 names are having a disproportionate kind of effect on the index, and so we could have a situation where they get really hammered, and I think that is very likely to happen.
Yeah.
And it kind of makes me nervous when both you and I are bearish on those top 5 names. The only thing is, it is 2020, and so far it's kind of a FUBAR year, and that FUBAR includes the fact that you and I can both be right at the same time.
That's weird.
And,
it's so
yeah,
weird. I still can't get used to that.
I know listen, we only have 3 more months. We might as well enjoy it. But I agree. Let's go through the charts because I think they look bad.
Yeah, like Facebook. Look at it. In the last few days, those lows that came in early in the week on all of these stocks, like Facebook, put in its lows somewhere around 265, held it for a day before it started getting hammered again, breaking to fresh weekly lows and 1 month lows even for that. And so the selling is just so pronounced. Apple, just fresh new multi-week lows, just giving back everything. It's almost like we nailed it with that sell on the stock split thing, right? Though I nailed it more than you did, because you said it was going to sell immediately. I said it was going to first go up before it went down, and I was more right than you.
Poor Patrick's feeling bad because he lost a bet and he needs to make himself feel good. One of the things that I'd like to highlight is the fact that if people haven't taken the time to go watch this Netflix documentary called The Social Dilemma, I highly encourage you to take time out to go watch it.
What's the stock symbol for that so we can put up the chart on it?
It's not. It's
just kidding.
But it's important because I think the narrative around the social media stocks has changed. And I know this has been a long time in coming. And it's not like any of the stuff that you see on this will be new. But I think it's hit a kind of a tipping point, if you may. And not only that, when you see Congress starting to go and threatening to institute rules on Google and Facebook, and I go watch I can't remember who was the guy. There was a very famous venture capitalist who turned into a portfolio manager who underwrote many of these companies, Facebook and stuff. He's basically saying something to the effect that these companies need to be either broken up or to be monitored. One of the things that kind of struck me is just one of those aha moments for me was they said, if you go and try to put a show on TV for a 5-year-old on actual cable TV, you're faced with all sorts of restrictions. Meanwhile, there's nothing stopping you from slapping that on YouTube. And I look at it and I say, I'm not sure whether it's right or wrong that YouTube is so free. And I'm not even judging that. All I'm judging is the fact that I think that there's going to be increased scrutiny on these companies, and it scares me to be long. I think that there's a lot of downside in a lot of these social media
and you know what?
stocks.
There's such huge behemoths in the indices that it's going to drag everything if that plays out. Anyway, they're definitely in a downtrend. The momentum, the wind has been taken out of the sails. Now the only question is, as they're rolling down the other side of the mountain here, does it turn into the snowball turn into an avalanche? And that's something that is yet to come. I mean, I still think there's more downside throughout next
Patrick,
week.
I'll take the other side because I think you have this vision of the selling in those 5 names creating a cascading effect on the whole index. And I've watched the kind of day-to-day action of, let's say, QQQ versus the KRE.
Oh, my God. This is almost like a bet setting up. You know what?
No. We got our bets on the other thing. But anyways, the QQQs versus the KRE, you go look at that. They seem to be inversely correlated throughout the day. It makes absolutely no sense, but it seems to be the case. I could see a situation where we have a monster violent shift within the market where a lot of these stocks go down by a third or maybe even more, and yet the other ones go and they get bid like you've never seen before. And one of the trades that I love, am I allowed to talk about my trades now, Patrick?
No.
Okay, I'll finish up and I'll tell you my trade afterwards.
No, all right. Let's go to it. You want to talk about your XOP QQQ trade?
Yeah, I love
go
this
for
trade.
it. Go
So
for
I
it.
think
Share it with everybody. Share it with the world.
I think that the energy is down and out. Nobody likes it.
I love
Everybody's
it too.
bearish.
Yeah.
Everybody's bearish. They all think it's going to zero. Every oil trader, has visions of negative prices again in their heads. The stocks are awful. They haven't gone anywhere in what, decades? Not decades, but a long time. And meanwhile, the technology stocks have all gone to the moon. But if you go look at this XOP over QQQs, you'll see that it hit a big, huge down move in the March low, but we've subsequently have bounced. What have you done?
Look at this chart. It's gone to 2008. Like, look at this. Look at this.
Oh, you backed out. So this is a long-term chart.
I'm just saying, like, this has been one of the most epic, going long the Qs against the XOPs, been one of the great trades of the last decade.
For sure. Listen, nobody likes it. Everyone's busy buying Elon Musk.
This is the momentum over value trade, just in a different variation. You're just being fancy. I'm with you though. You know what it reminds me of, when in 2015 and 16, when a lot of the gold miners were down there and nobody wanted to touch them with a 10-foot pole, and I said, like, this is just like, you got to load the boat here, and
bingo. Completely agree.
And this is a very similar situation. Anyway, all right. Thanks for sharing with us, buddy.
Thanks.
All right. So listen, I wanted to touch on a couple other charts here. First of all, I'll let you have your little oil moment here. So now but I want to talk oil. So it bounced. Now I still think there's vulnerability for it to kind of come a little bit lower, but I'm a buy on dip trader. I don't think it's going anywhere near the April, May lows on this is the October contract. So we're not even talking zero or negative. I'm talking about it ain't going back to the low 20s. I'm just wondering whether there's going to be one more buy on dip down into the mid to low 30s that offers you a better entry, or whether it just rips higher. I'm bullish, just like you are, but like the question becomes, you think it's just going straight up from here?
I don't know if straight up, but real assets are bid. It's going to continue. I think that the surprises will be to the upside on oil. Not to the downside.
And you know what? There's precedent for them. Our listeners shouldn't forget that even during the 2008 crisis, and when mortgages and stuff were blowing up right and left, and real estate was struggling, through the entire first half of 2008, all of these resource-oriented stocks and the commodities were all doing extraordinarily well in that early part, and then it really kind of all got really messy in the second half of the year. But I'm not trying to say that this is a deja vu of that event, but it's not. We've had other periods where the stock market was very weak and commodities were doing well in that environment, and so it's not. There are periods where this has happened before.
Yeah, you're making my point. Anyways, I think it heads higher. A year from now, you're going to wake up, oil's going to be significantly higher. That's all I believe.
Do you have anything to say about junk bonds?
Junk. No, it's not like, I don't know. It's not, look, it barely moves. It's not exciting. The Fed's in there keeping a bid to it.
But sometimes,
it's like the bond market.
but sometimes this is when the greatest opportunities lie. Nobody's paying attention. Vols contract. Realized volatility is narrow. You can quietly put on some trades, and volatility returns, and suddenly these things start exploding. Wow. I mean, do you think that this is just going to be dead, or are you the exact reason why nobody's paying attention? Like, just like, nothing's happening, so I don't care. And then it's probably an extraordinary opportunity.
I think, unfortunately, you're going to see a situation where bonds go very quiet. I think all the changes are going to now occur in the foreign exchange market as opposed to the bond market. So the rate volatility, even though it pains me to say, will be very subdued. And therefore, basically, you're betting on the credit portion. And even the credit portion, I think, is difficult to bet on, because the reality is that if we get any sort of meaningful, drop in these bonds, we're going to have the Fed step in there and just increase the amount that they buy. So I don't know, Patrick. Like,
my God, you know what? I'll take the other side of your trade for sure. I think that there's plenty of room for HYG to be nice and volatile, and all we need is things to get shaken up here, and then we're going to start seeing $2-3 swings in that. I don't want to say we're going to see a March repeat or something like that, but it's not going to be pinned like this. There's going to be some proper swings in this, and I think it starts with a move to the downside. Anyway,
that's what makes a market.
That's what makes a market, buddy. So let's talk some of these individual sectors, right? And so here I have the XLK, which is the technology. It's basically the chart of the QQQ, and just a different variation. And then you obviously have the social media ETF. It's not selling as much as the XLK, but definitely where some of the selling is. And another one that was worth looking at is the way that semiconductors are trading. They have broke badly, seems to be a little bit rolling over. But this is the space that was such an extraordinary bull market over the last 6 months. And finally, they're all correcting. And that's that space that's got the blunt of the selling. But what's interesting to me is what other sectors are not moving. Now, last week we talked a little bit about things like, for instance, the European markets have been pinned, and a lot of the developed markets are not reacting, and that's not a big surprise. And I think that real broad volatility kicks in when the developed markets of the world start to sell, and that has not shown any sign of starting yet. But what's interesting is, let's go to the financials. The financials the needle hasn't moved. First of all, they're nowhere near their February highs.
Right.
Right. Like, I mean, this is been nothing but a 61
by $7 off the high.
This actually is. I bet you. Hold on. Let's do this. Let's overlay the Euro stock and the XLF. I'm curious how much how much of a difference there is in their performance. 1 second here. Because like what we have is a scenario where they have not participated.
As you're trying to struggle with your charts there, like a complete putz.
Look, I'm done. I'm done.
One second.
Please make your point.
I think Bloomberg or somebody was talking today about the FTSE Bank Index. It was hitting new lows for this move, not seen since 1992.
Right.
It's ugly, and
but look at this chart.
Bank stocks are bad. European bank stocks are worse.
But we're not talking European bank stocks. This is the Euro Stock 50 index, overlaid by the U.S. financials.
It does look similar. I agree.
Right,
but almost all charts look, Patrick. But 1 second, almost all charts look the same except for technology.
Right, and hence why I would still say that there's a legitimate argument made that the bear market that started in February is still underway on a global basis, and that really just because the Nasdaq managed to rip to a higher high driven by those 5 stocks doesn't make it a bull market. That's
God, you're just not going to get out of that bear outfit, are you?
I'm not. I'm in. Yeah. I'm in. I'm committed. I'm committed.
You're in it. It's like 80 degrees outside, and you're sweating your balls off, and you're just like, I'm not leaving it. I'm in.
So, what's interesting? Consumer discretionary. Let's keep moving on. Starting to sell. Obviously, huge weighting of Amazon in there, and so this is, I think, like 15-20% of the index is just the one stock, and so as goes Amazon will go this indice. It's really rolling over, but and you can see consumer staples have also rolled over as well. What's interesting is that this is the healthcare. Healthcare is dug in here. It's still actually looks. I mean, it did make higher highs. It's been actually a place that's been doing very well. I mean, the initial rally in April was just extraordinary, and it really has been a muddled performance since. I mean, it's been crawling higher, but it's nothing to write home about, right? But interestingly, this biotech has been in a 2 month pullback. and had a breakout, but that's actually a lot to do with the IMMU takeover, right?
Yeah.
And that caused a spike, which makes it look like it's a bull breakout. But I would be a little suspect of that because you want to see the individual components all showing similar breakout. So I wouldn't overthink this breakout here. I think that this is you may be fooled by it if you're taking a technical signal based off of it. But industrials have held up very well. Now here's an industry that's been dogging it: the aerospace defense. Now I've been toying with like some Raytheon and other stuff like this, but this stuff just doesn't want to get off the mat at all. Have you watched any of those aerospace?
Yeah, I don't have a view. No view.
Yeah.
Sorry.
No, but okay, so let's move on. But look at the metals and mining.
Oh, love this. We're headed.
Right?
So like this is taking off. Like if you take a look at tech, pull that one up.
Yeah, tech resources, but look at all the copper stocks, like the tech resources and copper, but like beautiful breakout here. But like, yeah, look at the copper index, right? Like it's just been, it looks like a tech stock. Yeah, this looks like the Qs before they turned. Right, like copper stocks have been on fire. Freeport, Southern Copper, you name them, they've been running. But like, look at this. This is a fresh breakout in off a consolidation on the rare earths. This is the REMX.
Your rare earths. You love this.
Hey, you know what? When was the last time I talked about it? It was months ago. And what's it been doing since? What's it been doing since?
Yeah,
Thank you.
Hats off. Little clap. Little clap. Very well done. The whole market's gone up. So, but anyways, it's outperformed most. I agree.
Okay. So, but let's off the bottom. This has been an 80% rally, right? Like, I mean, that's not shabby. Anyway, so the point is though, is this a fresh new breakout? I like it. I think that this could be a new breakout candle. It might be interesting to see whether it follows through.
I hate to say it, I agree with you, but don't worry. It's 2020. We're okay.
Anyway, so we talked energy already. Our views are well known on that. Utilities have been dogging it, just nothing happening there. Home builders have been doing very well, right? But the thing is,
I knew somebody that actually liked home builders.
I have no idea. Come on. Well, okay, let's pull up the lumber chart and talk about that in a moment. But anyway, is this a double top? I want you to make the call. Is it going higher or is this a double top?
It's not a double top.
It's going. So say it. Then it's going higher.
It's going higher. Builders are going to be significantly higher.
Straight from here. Not that it goes down first to 42 and then ends up at 60 next year, and you'll say I was right. Like what's your time frame? Is it going higher from here right now? The next move.
I think good bull markets rarely give you a chance to get in. So I actually, if it goes down, I almost don't want it.
All right.
I sound like a technician.
Yeah. Okay, so let's look at this November contract on lumber. And why is lumber doing this if you're right about your home builders?
I don't know. It's like three guys sitting in a pit trading lumber. Remember Tony Blair told us the story about like there's literally three guys trading lumber?
Fair enough, but lumber's acting like shit.
Well, it's acting like shit, but it rallied from 250 or something.
Right, but you just said that the moment it starts selling, you don't like it anymore. Because it's a bull market and it's going to go higher. But why wouldn't lumber keep ripping?
Because lumber is different. It depends on how much.
I call bullshit on this. You know what? Look. I like the home builders.
I'm going to buy lumber when it gets down to 500. 500 to 450. I'm buying lumber. We'll talk then.
And then you're gonna enjoy your 3 days limit down, and we'll see how you.
I know. That's the trouble about lumber. It's like It's the Hotel California. You check in and you can't check out. Like it's brutal.
Yeah. Well, the good thing is that it works both ways, right? Because it could work in your favor the other way, right?
No, but you can always. Like, the trouble about that is you're long. You could always sell it into the limit bid like a complete schmuck.
Yeah. Anyway,
which I would do.
Which you would do. So this is the transports and IYT, and they've just been on fire. I mean, we had Angie or we're going to have Angie talking about that. And obviously, all the booking on the rails and stuff like this. I mean, this has been a very clean trend, and it's been working incredibly well. Do you have an opinion on the rails?
No, but I must say that was just a pro move. And when you slipped up, with the time frames about how we tape this. Very well done, Patrick. Nobody caught it at all that we taped Angie before this.
Anyway, all right. I think I'm almost had enough of you, so I'm ready to move on. So anyway, was this a little a prairie dog on the real estate?
I don't know. That's a little prairie dog.
That is a little prairie dog, but
I don't know.
It broke the higher high.
Maybe. I don't know.
Come on, it just guns all the stops sitting above.
People are seeing prairie dogs too often now. There's just prairie dogs everywhere now.
There always is prairie dogs everywhere. It's just now everyone knows what they're looking for.
That's true. Yeah. No, listen, I'm not a buyer of real estate for now. I think it heads lower. Next move lower is lower in real estate. There you go. I said it.
All right. Well, anyway, that is...
Okay, Patrick, that was a terrific talking charts. Let's get to our fresh interview that hasn't happened yet with Angie. It's our pleasure to welcome back to the show the one and only, the goddess of grain, Angie Setzer. Angie, thanks for being on.
Yeah, thanks for having me. I'm excited to be back.
We were just kind of laughing beforehand. You said that you could tell when there's been a good rally in the grains because all of a sudden everyone wants to get you on and chat about grains.
Yeah, it's been a while since we've had a decent rally, so I thought I just did a horrible job the last time I was on any of these shows. You know, they're like, "Oh, don't bring her back. She's terrible." But it turns out it's just because grains have been boring for like the last 24 months. It feels like so. Yeah. So now we actually get something really going, and let's rock and roll. So it's
right.
fun to be able to talk about.
So let's talk about this. So grains have been rocking and rolling. Soybeans seem to be leading the way. Why don't you give us kind of the big picture, what's happening in the grains market?
Yeah, I mean, obviously in all commodities, there's supply and demand factors that start to come into play. And so really we kind of had what you would call a perfect storm. So we're just getting started with soybean harvest. We're actually in a lot of places, you could easily say 2 weeks late or so. One of the biggest things that we saw, really start to kind of generate interest in buying soybeans, really took place around the August USDA supply and demand report. So USDA supply and demand report comes out in August with this monstrous yield, monstrous production number, really large carryout, comparatively speaking. From where we've been, almost 6 times what you could consider pipeline minimum or what you could consider tight stocks. So, not only is that adequate, that's kind of suffocating. And so we started out the month of August really with just this kind of really poor pricing structure in the market. And the weather forecast was pretty conducive to reasonable production. But all of a sudden, kind of out of the shadows comes in our friend China, and starts making some really large purchases, just some massive purchases almost daily. We're seeing these flash sales of, Chinese buyers buying this, Chinese buyers buying that, not only in soybeans, but also in corn. And that coincided with a drier than anticipated, warmer than anticipated August. And so the soybean crop is made in August. A lot of folks really say that you get a decent rain on a soybean crop in August and you'll make good beans. And so we actually saw the majority of the country go without rain for those very important 2 weeks in August. Now, it's very important also to point out that, we did start to catch rains the third and fourth week of the month. And, it's not an entire crop failure, but there really are a lot of uncertainties still about what's going on in the crop. And then in addition to that, we had these massive export sales take place. And so really you have to look back over exports over the last 3 years or so. And we haven't seen buying interest, really take place, obviously, since about 2018. The last year we had a really good export program, really was 2016. For a fall export program on soybeans. And so, we saw these buyers really get aggressive with selling. And in addition, they're kind of betting on the come because the weather looked good. So the production should be huge and beans should be coming by the middle of September and yada, yada, yada. And, and basically fast forward, here we sit, the beans aren't flowing like they thought, not necessarily because of production. We don't know what production looks like because we're just getting started with harvest, where in a lot of places like Mississippi, for instance, close to the Gulf there into that export terminal, they'd be starting the last week in August. And so they're 3 weeks behind. Some other states along the way are 2 or 3 weeks behind as well. And so there's kind of this perfect storm of, oh my goodness, where are all the beans? And where did all of this demand come from at the same time? That's really kind of created this catalyst it's a record setting rally, really, is what we're looking at right now in soybeans.
So let's talk a little bit about that demand side. And we saw China come into the market and buy aggressively. Was this the result of the floods that they were experiencing?
It's a little bit of that. Yeah. I mean, there's some conversation about that. I think one of the biggest things that it's a result of is, I'm not going to say that the trade agreement hasn't had a little bit to do with it. I think they're in their buying. They've agreed to buy, and here they are. But I think one of the bigger things that you're seeing too is a lot of folks had thought that that ASF, that African swine fever, was going to be bearish to soybean demand out of China for a long time. Well, it's just the opposite. I'd always been of the mindset that it was actually going to be bullish because it was going to create a modernization. It was going to expedite the modernization of the Chinese hog herd. So, prior to ASF, the majority of Chinese hogs were really kind of grown in backyards. Farmers over there, it's a very different setup than what we see here in the U.S. And the fact is that was part of what created such a catastrophic spread of the disease. It's really hard to maintain the biology of a virus like that when you're not able to really kind of work to create a clean zone for these hogs to live in,
Right.
And so what that's done is it's really kind of fast forwarded this process of them making sure that they are raising their hogs in setups similar to what we see in the U.S., very biosecure, very modern from a food standpoint, a ration standpoint that they're feeding the hogs, all of these things. And so that's really picked up the demand, you could say, when it comes to soybeans, because they've got to crush the meal for the hogs that they have. And so that's really picked up that demand. In the meantime, you've seen Brazil export record amounts of beans for March, April, May, June, and into July. And really, they were exporting like they had this infinite supply. Well, they ran out. I mean, they basically have run out of exportable supply. They probably shorted themselves a little bit, or at least are in the middle of a logistical nightmare when it comes to trying to get beans from where they are to where they're needed. And so we really don't have any competition right now in the short term either when it comes to satisfying, that bit of an increase in that Chinese demand.
Right. Let's backtrack to the pigs and the soybean, because a city guy like me is fascinated by this. First of all, the pigs that I'm all aware of is the one time we were going cat skiing, and we're up at this lodge way up above, and the pigs, there's 2 pigs on the property, and they feed them all the scraps. But I take it that's not how they feed most pigs, right? Like, so you're saying that they actually crush soybeans and feed them kind of on a commercial basis. There's an actual meal, and so the soybeans are going to feed the pigs?
Yes. So soybeans, when you crush soybeans, basically you end up with a certain amount of meal, a certain amount of oil, and then, basically the outside of the soybean, or the soybean hull is what it's called. And that in and of itself has feedable qualities to it. It's kind of like a roughage or a fiber. But the soybean meal is about 45% protein. So it's kind of the cornerstone of any sort of livestock feed because it helps them, basically put on weight, satisfy a lot of their needs nutritionally. And so it's one of the larger, like I said, one of the larger components of a ration for livestock, whether it's cattle, whether it's poultry, whether it's hogs. And yeah, when you say the 2 hogs getting fed the scraps in the backyard, that was really the way that the Chinese farmer, or really the way that the majority of Chinese hog production was actually produced prior to, this sort of change that we've seen with ASF coming into play.
Right. So let's talk about ASF. When did it hit, and how did it manifest itself?
Well, it all kind of blurs together anymore, it feels like. But it was late 2017, I believe. And so it really was a double whammy for us. It really helped the Chinese to kind of hold out a little bit when it came to the trade war, or the trade agreement, because they had seen such a reduction. ASF is very, very deadly to hogs. It's not to humans. It can't transmit to humans or anything of that nature. But typically once a hog catches it, it's basically catastrophic in the herd. It's extremely contagious. It's transported by wild pigs as well. So it's very hard to keep contained. And so that's one of the things that you were seeing, is that the Chinese government, especially with these smaller hog producers, they were really kind of able to create this black market for hogs. And that was actually one of the things that caused a greater spread. And so for a while there, you saw the Chinese hog herd cut nearly in half. And obviously that reduced the amount of soybeans that they needed, because they're not feeding meal, as we just kind of went over. And really kind of was a double whammy for us when it came to overall Chinese demand, in the sense that they weren't feeding as many mouths. So they didn't need to buy as many US soybeans. And I think that was one of the things that kind of allowed the trade war to drag out as long as it did. Not saying that it's, in any way, shape, or form done at this point in time either. But, we really didn't have to come to any sort of resolution, simply because they weren't necessarily using the amount of product that they had been using before.
Right. So we get a situation as the Chinese get more prosperous and more can afford meat. Mm-hmm. We're going to see ever increasing demand for soybean meal, and especially more so now when the Chinese farming has become more commercial in nature.
Mm-hmm. Yes. And the Chinese growers really don't want to grow soybeans. There's a lot of conversation about how the Chinese growers feel about GMO beans, the genetically modified components of soybeans. And so they struggle a little bit with being able to produce a larger amount of beans, I guess you could say, or have a solid amount of production, just simply because of the technology that goes along with it and things of that nature. So it's one of those things too, where the Chinese farmer, they're trying to get them to supply the marketplace, but the Chinese farmer really would prefer to grow corn or something else.
Right. Now, sorry, go ahead, Patrick.
Yeah, Angie, I was just going to ask you, like, when we're looking at this chart on soybean, it's like a pretty big rip to the upside. Mm-hmm. How much do you think has now already been baked in? Are we just getting to this now conversation when most of the move has now been baked in? Or do you think that there's more upside still here?
I mean, to me, I feel like a good amount of the move has been baked in, honestly. I'm a little nervous right now. We saw the headline overnight of the 18 fighter jets flying over into Taiwanese airspace. We've seen China come out today and say that, basically don't force them to retaliate when it comes to the TikTok. They called it a smash and grab. I'm not sure where necessarily that quote came from, but I do feel to a certain extent there could be, and so this is where we're at right now, right? And this is what I'm telling the customers that I'm working with. Is this a new move? Is this something, if we were to run into a South American weather issue, because they're just getting started planting right now, down in Brazil especially, and there is some La Nina weather patterns which could have some influence on production. I mean, there's an easy way to rationalize that this market could move, another dollar higher. There's an easy way to rationalize that China could really kind of be using this as a way to flex their muscles, so to speak. I mean, when it comes down to it, the trade agreement is really an agreement for them to buy a lot of stuff and just kind of be cool, right? Be cool, man. Like, don't do any of these things that we really don't like you doing, but there's not really a lot of teeth to it. From an overall, what they can and cannot do, that's supposed to be discussed in phase 2. And so one of the things that I really do worry about is one of the easier ways to really kind of make President Trump look poor going into the election would be to really kind of build this market up, create all of this demand, and then say that he did something to make that not happen, right? And so then they cancel. And that's one of the things that we've run into in the export structure. 2012, 2013, they discovered, a genetic trait in corn that they had been happily receiving for several years, but hadn't maybe officially agreed to receive it, you could say. And suddenly we had boats having to be redirected and contracts being canceled, and the corn market, kind of fell apart into the summer months because we lost this large portion of our demand because they had created, a reason for walking away from the contracts. So at this point in time, right, no one really knows what the plan is from China. Is it because of the flooding that they're really stepping in? Is it because they feel that they need to feed their people? Obviously the demand is there. Their hog herd's up 30% from a year ago. There's all of these things that we're seeing that would really indicate that demand is valid. But at the same time, you always have to tread lightly. I have a lot of friends that work in that export business, and they really are nervous that they're going to book freight because, in order to export, depending on how you're doing it, you have to be able to secure not only, the containers that you're shipping these beans in, but also the freight, the rail freight and the ocean freight and all of these things. And once you're booked into those, it's just like buying anything else. They're traded similar to commodities in general. And so once you're booked into those, you might be long freight on the expectation that you're going to be shipping these beans because you have these contracts sold. And if they're canceled, then your freight is devalued, your product is devalued, and you're out on both ends. And so I do have some friends here that are really hesitant to get in just until we know for sure that they're serious and not just kind of Lucy in the football, and we're Charlie Brown.
Right. So, Angie, to some extent, it's really a question of whether the Chinese are bluffing with the bids that we've experienced so far, and whether this is nefarious in nature.
Yes, that's the literally billion-dollar question. Right. At this point in time, because if this is real, and their quantities for import change, and we see this demand is valid, and I'm not saying that it isn't, like that's not fair.
You're just saying that this is the risk.
Yes,
it's a great point. Okay, so let's talk about the other risk, which is the kind of supply side. We've chatted about the demand side. Let's talk about the supply side. We're going into a period when you were saying that this is the time when the harvest is still up in the air. What could happen on the supply side to us in the next month?
Realistically speaking, based on what we're seeing out there in the marketplace and based on what spreads are doing, that's right now, traditionally in the grain markets, corn, soybeans, wheat, you have what we call carry. And so that's the next month in line is trading higher than the front month. And that gives you incentive to keep the crop out of the pipeline, right? Because we tend to when it comes to harvest, we have 16 billion bushel of corn supply available at the end of harvest, and we need to be able to ration that out through the next 12 months, not all bring it in at once. And so that's what the market structure is supposed to be doing, is encouraging people to hold. The soybean market is not. The soybean market at this point in time is telling the commercials, people like me and the farmer, that they need to be bringing it into the market ASAP. So it'll be interesting to see, the risk over the next few months or next few weeks, is that harvest comes in better than anticipated. The market structure right now is trading as though we don't have a supply, the supply that we thought we did, right? We don't have enough beans really to satisfy the export sales that we have on and the crush demand, and all of these things. And so the market is basically kind of pricing in, what would be a supply reduction from the numbers that the USDA is putting out. So I think the biggest risk also comes in that the crop is perhaps larger than anticipated. And then you kind of see this pipeline fill up, and people are trying to find a place to put beans because the commercials and farmers are trying to move them into the market structure because they're not being incentivized to hold on to them. So, obviously we don't know, but early yield results that I'm seeing across a great portion of the country are decent. There is some talk that, perhaps the beans aren't as there as what some had anticipated in some places, but we're early enough in harvest to where most of the beans that are coming to maturity right now really were more in that vital. Remember earlier I talked about there were a couple weeks, 3 weeks in August where we didn't get any rain across much of the country. So the beans that are coming into maturity right now really needed that rain more than anything. Whereas the other beans that won't be ready for another 2 or 3 weeks, they got the rains that they needed. Maybe it won't be a top end yield, but it's still going to be a decent yield. So over the next few weeks, we'll know a little bit more. But after having run up $2 from the August, the pre-report low going into the August USDA report, the risk isn't that the crop is smaller than we'd anticipated. I would say more so the risk for a lot of folks is that we end up with more beans than we'd anticipated, or are in line with the USDA, which would generate, a relatively comfortable carry out going into next year. Now, that's for the U.S. Obviously, South America is a different story. Brazil is dry right now. They're allowed to start planting. They have been for a week. A lot of them are holding tight until they get a rain. They rather would plant into somewhat moist soils. And so we're waiting to see what that looks like. And then that risk, obviously, is that Brazil does run into a production issue, and we see them shorter on supply than currently anticipated.
So, Angie, for tourist grain traders like myself, oftentimes I'll come in and just buy the whole complex. I'll buy soybeans, grain, corn, and wheat. So far, we've gone over the soybean market. What do you think about the wheat and corn market?
The wheat market is absolutely phenomenal in what it's doing. I mean, we are seeing some issues in production. We saw the Black Sea region deal with some drought, so their supply availability is a little bit lower than, anticipated in the past. We are seeing some folks really kind of step up and try to front run a little bit of these purchases. We've seen some export quotas out of countries that traditionally aren't necessarily looking to buy a large amount of wheat, so that's been interesting. In and of itself, I would say, honestly, if you wanted to pick, even after a $2 run in soybeans, if you wanted to pick the more overpriced market structure, I would say wheat is probably nailing it, as far overpriced at this point in time. Chicago wheat in particular, and that's the wheat that we trade. Carry-out values really aren't that much different from a domestic standpoint. Globally, we still have more than enough supply. I think wheat's just kind of picking up on the idea that it's been dry in Australia. La Nina tends to limit production out of Argentina, who's a larger wheat exporter. In addition, Argentina obviously is dealing with a lot of issues politically and economically that's going to limit their ability to be a large exporter probably in the next several months to years at the rate they're going. So there are some reasons that you could easily rationalize there's some need for risk premium, but the reality is, looking at available supply and the way that the market structure is working, I would argue that Dees wheat is 50 some cents overpriced versus where it should be sitting as we work our way into planting, because that crop's going to be starting to go into the ground here in the next couple weeks as beans get harvested. Wheat tends to be planted. And so people are making that decision. And I can tell you that 580 wheat futures in a lot of places, I'm speaking specifically Chicago wheat. There's obviously Kansas City wheat and Minneapolis wheat for different locations, but 580 July 21 wheat futures are going to encourage a lot of people who maybe haven't planted wheat in a long time to plant. You have to remember wheat acreage has been dropping off the last couple of years, not because of economic reasons, more so because of weather-related reasons. We've had some really poor falls. And this fall, at least at this point for the next 3 to 4 weeks, looks to be relatively warm, relatively dry to allow for, a relatively expedited soybean harvest and a decent planting pace for new crop wheat.
So, Angie, in wrapping up here, let's step back and think about this from a larger, longer-term perspective.
Mm-hmm.
Fools like myself have been waiting for the grain markets to take off, and we look at it on an inflation basis, like our adjusted basis. Grains have been just down in the dumps, and they seem to never rally. Is there any hope for bulls like myself that we could see a situation like 2, 3, 4 years from now, grains are significantly higher?
There could be. I mean, obviously there are issues with weather, and some pretty sharp changes in what we anticipate from a climatology sort of standpoint. And so it is very possible that you could have back-to-back production issues in both the north and southern hemisphere. Demand, obviously, we have more and more mouths to feed. And then you do have the inflationary argument. What does that mean? Do commodities become the golden child of investments again when other market structures start to falter? So, I mean, that's really been the argument that we've had, or the conversation that's been held here more so over the last 2, 3, 4 weeks, since the end of August. There is a lot of outside investors that are looking at these market structures, from a historical standpoint and from an inflationary standpoint too, comparatively speaking, and looking at the other commodity structures that are out there. And really saying it's time to buy commodities. Obviously they're way way underpriced, and they should be much higher. And so, yeah, it's a valid argument.
Yeah.
I just don't know overall whether it sticks or not. It always makes me think of The Big Short. The part where Steve Carell's character, they're sitting in the group, and well, what do you do? Well, I trade commodities. And he goes, good luck with that. And that's exactly why, right? Is because commodities tend to have this 500-pound gorilla in the room all the time, which is, it's much easier for us if Mother Nature willing, right? All farmers will work to, because the more they produce, the more they're able to produce, the more money they make. I mean,
Right.
It's silly, but it's that simple. And demand really is not able to grow, especially if you're looking at a market that's rallying. Demand is relatively, or can be relatively elastic, especially for like corn and things like that. You can see this real big cut in demand take place, on a relatively minor move higher. And then at the same time, you're encouraging the farmers to grow more because of that move. And so these big rallies tend to last all of, a few months, and then we're right back to, not being able to make ends meet, out on the farm gate.
So, last question for you, Angie. Over the past few decades, we've seen crop yields go higher and higher, and ultimately, that's why prices have kept going down, or at least stayed the same and gone down in real terms. Do you foresee a situation where that yield will stop being able to go up, and meaning that it'll plateau?
Yeah, I think you'll see a point where things really start to, I feel that way. I felt that way for a while, where eventually you only can get so much.
Right.
A lot of people argue that it's easy to well, eventually we have the potential of having 300 bushel a acre corn. Okay, I don't necessarily buy that too much, because it's grown on such a large scale. And so I do think we see that. I think we've seen it, honestly, over the last couple of years. I mean, the potential is there. The USDA in August came out with 182 bushel to the acre corn yield number, or close to it. And then this last go around, they kind of dropped that down back to that 179, and I still feel we'll end up closer, like a 177 or so, which is pretty comparative from a trend line standpoint, without seeing any sort of move higher. Now, granted, perfect weather across the Corn Belt could do a lot of amazing things, but that's harder and harder to come by, and so I do think you see a leveling of production potential, not on an individual level, but as a whole from a country, especially the US. Brazil and the Black Sea region are still introducing some of these technological advancements that we've started to take for granted here in the US. And so you could see their production really continue to grow. But I think the US, ability to see these top end yields, on a whole level, will start to stagnate.
Well, Angie, I hope, I guess I shouldn't be hoping for this, because it'll make grains much more expensive and food more expensive for everyone. But from a personal point of view, from a grain bull, I hope that we actually see a situation where this has plateaued and crop yields don't get any higher, because that is probably what's kept the grain markets down in the dumps for so long.
Yeah, the ability to see, and that's what we saw. I mean, in 12 and 13, we saw this massive push for acreage that really had never been in production either. for corn and soybeans in the U.S. come into production because of the higher prices. A lot of transitioning from what would have been specialty crops that had seen poorer demand over to growing corn and soybeans. And we're still seeing it. I mean, the one thing that we really have to be aware of right now is that Brazil has a boatload of arable land that is still not in production. That they could really kind of bring in. But then the question always goes back to, does that stretch out your yields more? You know what I mean? Does it dilute your yield potential? You may see your production continue to increase, but does that mean that from, like I said, from an individual level, it is not necessarily.
Well, Angie, it's been a pleasure having you back. For those who want to learn more about you and your all your great views, where can they find you?
Yeah, most of my commentary anymore is on Twitter. And that's at Goddess of Grain on Twitter, or you can email me at acetzer@citizenselevator.com. And our website has a plethora of information, from on futures where they're trading, what weather's doing, maybe some short blurbs about market analysis and things like that. And that's citizenselevator.com.
Thank you so much for joining us.
Thanks for having
Angie.
Okay. Time for WTF Clip of the Week. Taylor, hop on.
Hey, what's going on, guys?
Not much, man. How about you?
Good. I'm just drinking this Minister beer.
Yeah.
And it's a lot like, I don't know if you've ever dated someone who's a lot taller and broader than you. But it's like that. It's like a very...
Are you sure that wasn't a guy?
Yeah. Gorgeous long blonde hair, Adam's apple. No, it's just like, lot pretty, pretty. You're like, oh, pretty. And then you're just like mincemeat. This is what this beer is. It's very pretty, but then it's like, whoa, okay.
Oh, I love it.
You want to meet
my problem is I'm a little thirsty, and I've gulped it down, even though, as you can guess, I don't really like it, and it is a little strong. And I'm giggling a little too much from a schoolgirl. Okay, so let's do this. WTF Clip of the Week. What do you got for us, Taylor?
Okay, so I don't know if you guys are familiar with Dick Fisher. He was the ex-Dallas Fed president with a reputation for having a colorful way of saying things. Like in 2012, he famously went on the news and described his breeding bull, which is a real animal he owns. It's a breeding bull. Yep. Named Too Big to Fail.
Nice.
He described this bull as full of liquidity, but unable to reach the pretty cows on the other side of the fence. So, right? Like,
sounds like
says this stuff.
19 years old. So for those who don't know, Dick Fisher was also a Fed governor, right? Or a Fed president, one of the ones.
Yeah.
He sat on the
Dallas.
FOMC.
Yeah, Dallas Fed. And he had, I think he was for 10 years, and he was really colorful and all this stuff. So anyway, this week they bring him on CNBC to try to explain to the layman what's going on with the market. And his go-to relate to the everyman analogy is that the market is pretty much just speedballing. He's like, you know what I mean, guys. It's like when you do a bunch of coke and then you take some downers to level out. So it's coming from a banker. It's absolutely perfect. So I hope you guys enjoy.
Since the end of QE3 back in 2014, it hasn't been quite as robust. I know you've warned about the efficacy of the last QE. But do you think that central banks still have the power behind this stock market?
I think that power is running its course. I like to say that we injected cocaine and heroin into the system, and now we're maintaining it on Ritalin. How's that?
Come on, call the ambulance. Get off here, call 911.
You know how do you come back to that one?
It's so good to get a Wolf of Wall Street in there.
That was awesome. And you know what's the best was that when he laughed, none of the anchors were laughing. It was like he was laughing at his own joke. And they were just like shocked. Am I allowed to laugh? Am I going to get rid? That was hilarious.
What was he thinking, you think?
Oh, you know what? the problem is I would have said the same thing if
Oh, yeah,
I was...
but Patrick, you say stupid shit all the time. What was he thinking?
I don't know. I think he gets enough attention. Everyone knows he's got a reputation uphold. He's been out of the spotlight for a while. He's like, you know what? I'm going to give him a little bit of something. Who cares? He's still got his like yacht, his ranch, and his too big to fail bull.
Breeding bull, yeah.
Yeah, breeding bull.
I'm just going to pull them out and put them on the table.
And if you rewatch that clip, there's a bunch of like, it's pretty quick. So I added a bunch of little things here and there. So there's a little, he's choking on some QQQ at the end there if you didn't catch it. But check it out. It's pretty good.
All right.
That's awesome, Taylor. Thanks a lot, bud.
Thanks, bud.
Of course.
Okay, Patrick. This week in trading history, what do you have for us?
Oh, we're circling back. I thought it was appropriate to go back. I mean, it was in September back in 2008 when we had the last really big shit show in the markets, and so how could we not revisit some of that history? And so it was back on September 15th of 2008 when Lehman Brothers filed for bankruptcy. So let's just have a chat about it. It was September 15th, 2008. Lehman Brothers filed, and they had $639 billion in assets at the time and $619 billion in debt. It was the fourth largest investment bank in the U.S., with assets far surpassing previous bankruptcies that happened earlier that decade on WorldCom and Enron. So the Lehman Brothers, let's go through a little history. Lehman Brothers were German immigrants who founded the dry goods general store in Alabama in 1844. For the next, yeah,
Lehman Brothers was originally a dry goods establishment.
Yeah, and for the next 164 years, they survived business crisis after crisis, railroad bankruptcies of the 1800s, the Great Depression, 2 world wars, the capital shortage when they were spun off from American Express, and the Russian debt default of 1998. They survived it all. But instead, their death nail would be rushing headlong into that subprime mortgage market, and it cost 25,000 employees their jobs. And so it was in 2004 when the stock price was around $45. They jumped onto the housing boom bandwagon by acquiring 5 mortgage lenders, even though those companies never provided full documentation. The Lehman Brothers real estate business saw their revenues soar 56% in just 2 years, faster than any other investment bank in the U.S. Their stock hits $86 at its peak, giving them a market cap of $60 billion, or 1/6 of what Tesla was at its peak. So just to give context on that, but
you're going to just relate everything to Tesla.
No, I'm not. Why would I do something like that? But it was February of 2007. So we're now talking, 18 plus months ahead of when they filed. The national defaults of subprime mortgages rose to their 7-year highs. So things just the warning signs were all over the place. Investors feared that this would hurt Lehman, which incited the biggest one-day sell-off in 5 years. Yet the very next day, Lehman reported their highest quarterly revenues and profits. In that conference call, the CFO stated that home delinquencies were contained and wouldn't impact their earnings. We've also seen something like that at the beginning of every Jurassic Park movie, right? It contained, and then look out. But anyway, so it was in August 2007, so a few months later. The credit crisis caused major issues in the mortgage-backed security market. Bear Stearns had to shut down 2 of those credit hedge funds, while Lehman Brothers laid off, at that time, 1,200 people. Even so, that year, they underwrote more mortgage-backed securities than any other firm, accumulating an $85 billion portfolio, or about 4 times its shareholder equity. Even as global equity markets reached new highs and fixed assets staged a temporary rebound, Lehman did not take advantage of that opportunity to take profit and trim its massive mortgage portfolio, which in retrospect was their last chance. It was in 2007, Lehman at the time was 31 times leveraged, and the public feared that Lehman would be the next Wall Street firm to collapse. This caused its shares to plummet 48%. At the time, 2/3 of their debt was in these credit default swaps, essentially the equivalent of selling puts on these mortgage-backed securities. So you could imagine with poor lending practices, many of those mortgages would default and they would be forced to pay out all that money owed. So Lehman trimmed the fat. They reduced some of the exposure to that failing real estate market by 20%, cutting their leverage to about 25 times. However, it was too little too late. And then during that crash in September 2008, the CEO tried selling off a bunch of commercial assets only to receive a very public rejection as the stock dropped another 45% in very short order. Hedge funds and creditors began jumping ship, and Moody's Investor Service, after laying low for months, announced that in their final review of Lehman's credit that the only way for Lehman to avoid a rating downgrade would be to sell a majority stake to a strategic partner. So it was over the weekend of September 13th where Lehman, Barclays, and Bank of America made a last-ditch effort to facilitate a takeover of the former, but they were ultimately unsuccessful. And so it was that Monday on September 15th, Lehman declared bankruptcy, resulting in the stock plummeting a further 93% from its previous close on September 12th. And so, as a little fun as to where they are now, CEO Richard Fudd sold his New York loft and some of his art and now runs Matrix Private Capital, a firm that manages high net worth assets and is still fairly critical to this day about the U.S. government not bailing out Lehman Brothers the way they did the rest of the other banks. So, well, Richard, if you look around the poker table and you can't tell who's the sucker, right? Anyway, so we'll leave it at that. That's This Week in History, buddy.
Well, Patrick, you don't realize it, but he's not a poker player. He's a bridge player. And he smokes a lot of grass. So I suspect that he's actually high and playing bridge right now.
There you go. Anyway, that's This Week in Trading History, buddy.
Okay. So, Patrick, it's time for our new segment, No Stupid Questions, Just Stupid Answers. And for this, we'd like to bring Lena on. She's a fan favorite. Much people enjoy her a lot more than us.
Let me see if I can read this question properly after this beer. I'm kind of tipsy already. So the first question from one of our listeners, are there inverse prairie dogs like when Bugs Bunny digs down so deep he ends up upside down in China? Will the market break below the 50-day moving average in an inverse prairie dog?
I don't know if that's actually politically correct. I don't know if we're allowed to say that. Okay, Patrick, answer it.
Well, there are definitely reverse prairie dogs. In the spirit of what prairie dogs are, these short-term little surges in the market that kind of break the market out of a range and signal the potential start of a move. And what usually happens is it's an advertisement to the trading community that it's at least a game-on attempt for a market to go and to start something. And the way I always describe it is that, well, you know, like a prairie dog, it's like the market pops its head above a level to discover whether or not things are safe or whether there's a new trend coming, and it waits to see if everyone else joins the party. If usually a technical breakout like that should spur technicians and other traders watching this to take attention, and that should draw liquidity usually to actually accelerate the trend and feed the breakout. And so when a market breaks above a level and does not follow through and comes back, then it's a fake out, which we call the prairie dog. That happens to the inverse for sure. You know, whether we call it a loon dive or a hawk dive or whatever, what names did we give him?
I don't know. We got to come up with something better, though, than those. Those are terrible.
Those are terrible. But nonetheless, they exist in the same way. And certainly, there's a chance that the market, the S&P 500, could, inverse prairie dog below the 50-day moving average in reverse. It's entirely possible. I doubt it, but we certainly can't rule it out. But it does work both ways. Did I describe it right, or did you want to add something to that?
Well, I want to bring up an example, or at least what I think is an example. I don't practice the dark art of technical analysis, but December or March of 2009, Patrick, is the S&P. Was that an inverse prairie dog?
In 2009?
Yeah. It looks to me like it was an inverse prairie dog.
Pull it up. On a second. All right. 2009. Weekly chart is fine?
No. Let's do them daily.
My God, you're going to make me go way back.
Can you not go back with your?
Well, yeah, I can. I
just drag it.
That's the only way I know.
Whoa! You're not allowed to say that.
Whoa.
All right, edit that out.
No, Lena, just bleep it, and then we'll keep going. Okay, so just go bleep and then go. Whoa! I'm not allowed to say that, and we're going to keep going. Okay, Patrick, go ahead.
All right, so here we have that chart. I actually don't think that this is. Well, I mean,
Come on.
No, I don't
Why?
think so. Because in from the way that I do technical analysis, each one of these drops were actually measured moves. I actually think that this when this drop happened and the length of these two drops were proportional in their length. No. I vote. I would not call this. I
think if you flip this around and you times that by -1, it would look like a prairie dog. I think you're wrong.
But you don't practice the dark arts, so you don't get to vote.
Well, could be. Lena, what's our next question?
The second question. First of all, there's a comment already. Love the show. Thank you. So the question is, I remember a post on Macro Tourist where Kevin was trying to replicate exposure to a pure inflation expectations play using tips and treasury bonds. The conclusion was there was no easy way for retail to get exposure to this. Can you guys review RINF ETF? I think this does the job. What am I missing?
You are not missing anything. It does indeed do the job. Unfortunately, it's only a $7.85 million ETF. And not only that, it has a huge expense ratio. It's 1.75 on the gross and with an extra 30. So you're basically paying someone else for, a very illiquid instrument. But having said that, there's nothing wrong with it, and especially if you hold it for the long term. The trouble is that this is a very skinny kind of trade. It's not something that has like a huge volatility. So one of the problems is if you're paying 2% a year, it's going to eat into your returns a lot. So you're not missing anything except for the fact that it's illiquid, small, and has a high expense ratio.
Right. I mean, otherwise you have to go and directly play it in the futures market. And
but listen, I get it. If you just wanted to nibble at the edge and have this as a just in case, or if you wanted to trade it around, there's nothing wrong with it. For me, I have it as a majority portion of my portfolio, so I'd rather just kind of create it myself and do the trades that way. But thanks for the question.
There are other ways to play inflation, right?
There's no other way to play inflation break-evens that I'm aware of. If someone knows
break-evens, but the thing is that if that goes ripping higher, that means other things that are sensitive to inflation will also be doing very well.
But those are always second derivatives, and I like owning inflation break-evens. But I'm a different bird.
Oh my goodness. Okay. All right.
Thanks for the questions. Listen. Those were great questions. Hopefully they weren't
just
completely
stupid answers by both of us.
Yeah.
By the way, just Lena, you want to tell everyone if they want to send in questions?
Yeah, if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Or if you have any for Lena, you can also send it to the same place.
Yes.
Poor Lena's like, no, please don't. Okay, Patrick. Time for skin in the game.
Well, first of all, why don't you give quickly a rundown of this?
Okay.
First of all, let's first actually go through the rules.
Okay. So the rules are every week, the winner, although in the past time we didn't have a winner, the loser. We didn't have a loser last time, so I arbitrarily went first. The loser goes and creates a bet that will settle in the following week and offers the other co-host the opportunity to take either side of that bet. So the co-host on the other side chooses what side he's on, and then we keep kind of escalating the bet in terms of the wager, what's at stake by the market Huddle currency, which starts with a Duke and Duke, which is $1. Obviously, everyone should know that. Then it goes to a pint of beer, a burger bet, a pitcher, a case of beer, bottle of wine, steak dinner. We keep escalating until we hit a point where we agree that we don't want to go any higher. One of us stays, and that's it. So last week, I presented to you a case where the S&P September contract would settle, and I was talking about the expiry on Friday morning, would settle above or below 3280. And at the time, that was kind of 40, 50 points lower. And you were bearish, so I knew you would be tempted.
Oh, it wasn't fair. But you know what? I had a reputation to maintain.
You know what? This is such BS.
And this is why you did it. You did it because you knew that I was going to take it. And so this is why you gave yourself an edge. You're a typical market maker. Yeah. You're like, you know retail's going to go for it. And so I
dangled the carrot, you took it, and you paid dearly.
You know, it's unsportsmanlike.
It's not unsportsmanlike. This is what trading's all about. I'm not going to fall for it. This is what I predict. I don't know. So, by the way, the loser gets to make the bet for the next week. I don't know what Patrick's going to choose. I was talking to Lena and Taylor about it. I think you're going to try to take advantage of my bearishness on bonds. And
you nailed it. All right, we'll talk about it.
So,
but listen, let's just settle this first.
Okay.
Let's settle this first.
Okay, well, anyways, you lost. That's all there is to say about it. It wasn't even close.
All right, so a pitcher. First bet goes to Kevin. I owe you a pitcher of beer.
That's right. Okay,
done.
So let's go.
Okay,
so let's go.
So this week, listen, you nailed it. I'm going right there, but I'm going to make this very, very fair. Okay, 10-year Treasury yield.
Okay,
right here. It's pretty much at 70 basis points. And so I'm just going to give it to you straight up. Over, under by next Friday at 70 basis points. I'm not going to, just straight up.
So I get to choose, and what are we going to use?
What's
Friday's close?
Yeah, when we're taping the show, this number right here that says 0.697, is it going to be above or below 0.7?
Okay, so first of all, let's be precise, because on my Bloomberg it's showing 0.6937.
No, we're using Trading View, this chart, whatever this is showing.
Okay. Oh, God, that's tough. Actually, that's a good one. It's a good job. Good.
Sorry, can I interrupt for 1 second? We have to tape the show on Thursday. So this is not going to get settled if
Lena knows.
If it's for Friday.
So we got to adjust it.
So either we settle it at a regular like a Twitter thing.
No.
So Thursday. We'll settle this Thursday.
Do it again and say we have to tape the show a day early. We're going to do Thursday. Or don't even say anything about the shape. Say something. We're taping.
Let's just leave this all in, and we'll just tell everyone we're settling Thursday.
Okay, we're leaving it in. Sounds good.
And Thursday it is. Thursday, when we record this show, at the time we're recording this, is this number going to be above or below 0.7?
Oh, God, Patrick. You bugger.
I'm being completely fair, right? Like, I'm not doing any of your kind of little shenanigans trying to give an edge because I know you have a bias. You have
Don't give me that crap. Because if you gave me any, I would take it the other way and go long bonds.
Fair enough. So I'm giving you a fair shot here. So 70 basis points. Go for it. Duke and Duke. Pick your side. Above or below?
I'm picking it's going to be below, bud. I'm going to piss you off. I'm going lower. And bonds are going to be higher. It's going to be a tough week in the market.
All right. So you're starting the wager at
Duke and Duke. And obviously you're not going to bet the other way because I know your tendency. So it's probably, unless you want to up it to a pint of beer. Am I allowed to up it or you? I can't remember.
No. You take it. I have to up it.
Yeah.
No, I'm going to leave it at Duke and Duke.
Yeah.
I'm leaving it at Duke.
Boring.
Well, he should have taken the bond bear side.
I'm just proving that I will trade what I think. Why would I enter into a bet that I thought was going to go the other way just because I got a reputation to uphold? Not a chance.
That's
Okay.
only something stupid like I would do.
Exactly. You know what? I feel a little bad for that. I'll tell you what. We'll do
Oh,
this,
just
Lena.
stop it.
Lena,
Stop
Lena,
it.
I'll give him a Duke and Duke, but if I lose, I'll give him a pint.
What? No, stop this shit. I want no.
Well, then
no,
up it.
no
I
sympathy
agree.
shit.
Up it
no,
then.
no. We're leaving it at Duke and Duke.
That's
and none of this. Oh my God.
American dollar, though. We're
Yeah,
talking
of course
about,
we're
right?
talking
It's
American
like
dollar.
$17 Canadian. Okay. Well, there it is. Pride means way more than the actual bets. By the way, for those who don't know, this is like in terms of settling these bets up at the end of the year. It's there is no netting. This is not a swaps market. There is no netting. If we win 4 steak dinners, we have to actually deliver 4 steak
Settle.
dinners.
That's
Settle.
right.
Yeah, that's right.
Yeah, no, this physical delivery
Of
on
all
all
bets.
contracts. That's right.
So it'll be 52 different bets that we need to deliver on. So there could be a fair amount of drinking and eating and a lot of different things.
Maybe
going
we'll
on.
have to have a few of our listeners help us out with some of
That's
this.
true. Maybe. Well, we'll come in and we'll enjoy all the things that Patrick.
While you're wearing your menswear, which the COVID has messed
right.
up our.
That's right. I still have to do. I lost a bet, a very bad bet, and I lost it. It was on inflation. I was a little early, and I have to wear the Market Huddle's menswear. Anyways, Patrick, that's a great bet. Unfortunately, I did call it. I told both Taylor and Lena that you were going to try that on me. It didn't work. It's not going to work. I'm one
so
step
amateur
ahead.
at this.
Yeah, I'm one step
so
ahead of
amateur.
you.
I should have gone to the home builders because you already made an investment.
If I, you know what? If I lose this and I can get you next week, it's going to be a lot of fun. Anyways, that's it for Skin in the Game. And that's it for the show. Thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and I. You can listen to the Market Huddle on all networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, please rate and review us on iTunes. It's a dumb game, but it makes a difference to Apple's algorithms and helps us out immensely. Patrick, where can they find you?
Well, you can find me on Twitter at Patrick Ceresna with 1 R. And you could also find me at bigpicturetrading.com. Where can they find you, Kev?
Patrick, I'm on Twitter at Kevin Muir, M-U-I-R, or you can follow and go get some information in my newsletter at themacrotourist.substack.com. And if you want to see a sample or two, feel free to give me an email, kevin@themacrotourist.com, and I'll send you off a couple of my recent posts. And listen, we can never have too many friends on this crazy ride. We're just happy that you tuned in. So thanks for being a part of our show, and stick around for the after show.
All right, Lena, Taylor, hop on.
That ending wrap up was a little bit difficult, eh? Kind of slurring your words there.
Did you see that? It actually, you know what? I'm not usually one to have trouble with it.
I know.
For some reason, I must not have eaten enough for something at lunch.
Hey, you know, I think yeah, go ahead.
I do agree that I was not in my finest form, and it's a little embarrassing. Maybe it's the fact
we're slowly approaching our 100th episode, and you think we would have gotten better at this?
Well,
and we're not.
I think
We're
it's
not.
Patrick. You know what I think it is? I'm drinking less. I don't know about you, but like this COVID and not going out boozing and stuff. I'm drinking less. Like I'm down to just Fridays.
I'm obviously doing all the drinking for you because I would argue that the exact opposite happened.
But you don't get any better at it though, which is the unusual part.
Better at the show? I'm better at drinking.
Well, no, but I would argue neither. But what am I? Okay.
I think you guys should really double down on this theory here, and like instead of just have more drinks, do more drinks, and then do trading after that. You guys ever trade like hammered?
No.
It's back when I've heard.
I dare you.
Heard, right?
I dare you guys.
heard.
I dare you guys to trade.
I know someone that knows someone that has a question that was.
Well, nobody beats Jimmy Jude's story about in the pits when he.
Oh, the drug story.
So good.
Yeah,
that's nobody.
You should hang out with Dick Fisher a little more. So listen, I'm a little. I want to talk about somebody that's impersonating my good friend Patrick Ceresna on Twitter.
Well, let's rate the beers first.
Oh yeah, we got.
I'm sorry. Yeah, okay. Okay.
All right, who's first?
I'll start. Okay, I like the picture of the priest's hands. It's giving me kind of. It makes me feel a little spooky, but it's good. It's a little sinister, which is what you should have. Sinister minister. The actual beer itself. I was worried when I heard it was going to pour orange. Whenever you hear that kind of shit, you're like, oh my God, it's going to be disgusting. And it wasn't that bad. Maybe it was the hints of the pine cone. Anytime you got a kind of an evergreen tree in there, like you're putting in pine. I'm a buyer. I'm a Canadian. I guess that's just part of my nature. I'm going to give it a 7.2.
Oh, that's pretty
which
high.
is unusual.
What?
Yeah. Yeah.
That's high for you. I was totally thinking you were going to shit on this beer.
Nah. Maybe it's, they got me a little bit tipsy enough that I actually.
Yeah, there you go. Got you drunk enough to give it a good score.
Yeah. 7.2.
All right. Taylor, how about you?
Well, to me, I don't drink beer that much anymore. To me, this is like you need to get the party started quick. This is a shower beer, a very strong, cold shower beer. And I would give this about an 8 on utility because it's also an IPA, which I do like.
Okay. 8 on utility. What about
8? Yeah, just based on utility. Yeah.
Okay.
Taylor's showing his amateur status again with the even up numbers.
You're
I don't know what's going to happen.
First decimal.
I don't know what's going to happen if we're ever going to get him to go full pro, but we're hoping.
We're hoping. Lena, how about you?
Full disclosure, I was telling Taylor earlier before we started recording that I had a weird kink in my neck and I've been wearing a neck brace all day.
Really?
So the beer tasted better?
I drank it and the pain is gone. So I'm going to give
it's a miracle. The sinister minister was praying for you.
That's
Lena,
correct.
you're like that character in 16 Candles. I think it was John Cusack's sister played it, and she had a neck brace the entire time. That's what I kind of picture you as.
So yeah, I've been sitting here with like an inflatable like neck stretcher thing to hold my head up. But this beer took all the pain away, so I'm going to give this a 9.2.
Nice.
I will definitely drink this again. It was really good to drink, but it also took my pain away. So slippery slope to an alcoholism.
Like that's like a perfect advertisement for them.
Lena,
that's awesome.
It took your physical pain away. It took my emotional pain away.
I was hurting inside.
You put alcohol on an outside wound. You also put alcohol on an inside wound.
That's right.
All right. Well, listen, I don't want to. It did heal Lena, which it makes which gives it a pretty high score. But I don't want to take her glory away. I'm going to give it an 8.9. It's a delicious beer. I would buy it again, and anyone who can get their hands on it, it is worth getting. I liked it. There we go. Now let's
talk about your imposter.
Yes.
So there's someone impersonating Patrick Ceresna on Twitter. Why anyone would want to be Patrick Ceresna is beyond me, but there is somebody.
And they're pushing crypto.
I know. That's the biggest giveaway that it's not Patrick Ceresna, right?
Wait a minute. If that's an imposter, who am I sending my money to? Oh no!
It's not to me, damn it!
Oh no! Nobody's winning in this situation.
Oh,
Patrick, it makes me think you should maybe pick up the crypto.
No, it's no.
Yeah, can you imagine if Patrick starts sending out emails that are like, "Hey guys, invest in Stellar. You guys remember Stellar? You guys remember Fun BTC? See, these are only crypto jokes that only crypto people will get. There's some people out there that are like, "That's good. That's good, Taylor." I remember those.
Fun BTC. I gotta Google this. What is it?
Oh, it's just like a casino coin. Oh, you put your money in, it's a coin that goes, and you can use it for all online gambling. It's classic bubble. It's where I learned how to lose money the fastest, I think.
Yeah,
that was it.
So, But this guy, like, it's so hard to get Twitter to respond. Like, I've been trying for over a week. I've put a number of tickets. I've tried emailing Twitter. I've tried everything, and like, I can't get them to respond.
Well,
thankfully, our listeners have been helping out by blocking and reporting this. But like, the guy's still out there.
Well, okay, so let's put it out there. For those who don't know, help us out by blocking. What is it? How do I find this dude?
It's my Twitter handle, the Patrick Ceresna.
Yeah.
But with a double R in Ceresna.
Yeah. Well, it's
So what about this? What about, have you tried reaching out to him, Patrick? Okay, because hear me out on this. Reach out to him.
No,
like,
he's blocked me. That's the first key thing they do. They basically, the moment they impersonate you, they block you. So I actually can't communicate with him. He blocked me.
Do you think he's
what you could?
You should create another. Hey, now.
That's not very nice.
Well,
probably
it's English second language. I could see from the writing there, so it's definitely from somewhere.
Lena, you can bleep out what I said in terms of the different nationalities.
I'm leaving it.
And let it know. You can let everyone guess what I did.
See, maybe what you should do, Patrick, is you should we'll get this guy and be like, hey, man, you know what? You just want money? I'll send you some Bitcoin, right? So then get his Bitcoin address, and then we can look it up and see how much money this guy's got in his Bitcoin address.
Oh, you can do that.
You should also create another Twitter account with 3 R's in your last name and then contact him, maybe.
Oh, yeah.
There's another solution.
What's going on? Who's the final bar SCTV? He keeps retweeting these things. What's this?
Oh, where? What?
Like, if you go look at what this guy's retweeting, he's retweeting
He
the final
retweets
bar.
basically anything.
No, I
that
was on.
tagged in.
That was Dave Keller.
Oh, you were actually on a show.
I was on with the final bar with Dave.
You didn't know?
No, I
He cheated
didn't
on
know.
you once again.
No, I cheated on you
I know.
again.
He keeps his other relationships very secret.
Well, if it's any consolation, it was a quickie. I listened to it. It was very short.
I hope you use protection. Is all I can say. As long as he uses protection, I'm fine with it all. Okay, next topic. Let's go find out. Does anybody watch The Social Dilemma?
Yes, it's a must-watch.
Oh, I agree.
It's a must-watch.
Awesome.
It
How
makes me
about
kind
you?
of scared about my
It's
phone.
on Netflix.
Yes, you have to watch it. This is one thing you have to watch.
90 tomatoes. I just looked.
Is that good?
90 tomatoes? Yeah.
90 rotten tomatoes.
I don't know. Oh my
Patrick,
God.
what's the last movie you watched?
I can't tell you that.
It's not from this century.
What's the last
Austin Powers.
family-friendly movie you watched? Yeah.
Austin Powers 10 years ago. There you go.
Yeah. No, it's good. You spend all your time trading and looking at charts, man. I get it. That's what I want in my trader, man. You're my.
I'm focused.
For sure.
I'm focused.
He does. He is a hard worker. Like, I get
my
this shit
God.
on Sunday. Like I'm a big picture trading member. I get stuff on Sunday. I'm like, when the hell did he have time to do this? I get the macro update on Sundays or whatever. Luckily, I just hit delete right away. But anyway,
No.
But it's still clogging on my inbox on Sunday.
You should just mark it off as junk mail and it won't show up in your inbox.
No, come on. He's a good guy. He's awesome at talking about
God.
different things like that. And actually, he even gets to, like, a lot of calls right.
You know,
What?
that's probably
Yeah.
why he's got an imposter on Twitter.
It's true.
You know,
Like, I was joking.
It's-
And he's a true trader.
Oh my God, guys, stop this! All right.
No,
Like,
but it's
oh,
true.
he's
I'm
blushing.
here.
He's blushing
I'm here.
through
You guys-
the audio.
No, honestly,
Yeah.
you were bullish tech. Look at that thing run, right? Like,
okay.
you were bullish. Okay,
Keep
I
going.
was.
More.
More.
I don't know all the other ones. I don't read all.
Yeah,
your
there
shit.
you go. Stop it. You're just bullshitting. All right.
No, but
That's
honestly,
it.
I'm not actually bullshitting. Like, I do think, apart from some of your crazy zero hedge type deflation theories.
You mean, yeah, like the fact that I've been right for the last 3 years while you've been waiting for the inflation boogeyman to come, and finally one day it will come and you're going to be like, see, I told you so.
Yeah, you knew.
Like 3 years
you knew
too
COVID
early.
was coming. You knew COVID was coming. I love these bond bulls that'll be like, oh yeah, look at the bonds.
Give me a break.
Yeah.
Whatever. You know what? You're gonna get me triggered. I'm gonna ignore you right now.
It's just funny because when I see there's a certain FinTwit guru who Patrick also likes, we won't say who it is. And whenever someone tweets me and says, "Have you checked out this interview with blah blah blah?" and I go, "Patrick, this is one of your guys." And let me just say, he's a deflationist, and he thinks bonds are probably going negative yields. Anyways, that's Patrick. Deflation.
But stop this, all right? You're putting words in my mouth. I actually am long inflation trades right now.
Do you like that guy that
Listen,
we're talking about? Do you like?
No.
Do you have pictures of him in your room up on the wall?
Yes, I do. Yes, I do.
Is it Dave Portnoy?
No, it's not
Dave Portnoy, isn't it?
Listen, I am long a whole bunch of things that benefit from inflation, and so I am not a deflationist the way you label me.
So it's true.
But I simply think you were early to the trade.
Okay.
And there's definitely room for that trade to expand, and I'll be along with you when it happens. I don't think the world ends in a deflationary implosion.
So
Now, at least
Patrick,
it won't last very
the
long.
difference between you and all the other deflationists is that you like making money, so you don't let your views get in the way, and you stick to them. So
because I know this one guy that's been bearish bonds for 3 years and losing money every single year on it.
Okay, touche. I agree.
Well, I don't know if you guys are actually interested in making some money. I started an impersonator Twitter account, and I just push crypto.
Because crypto is the greatest digital gold, and it's going to.
Just right now, it's the end of the show. Our young guys and then you just have to lay it on at the end.
Yeah.
Just in case they were about to unsubscribe from everything, you just have to come in there and just give them that
little bit.
They're
push
gone.
them over
They're
the
gone.
edge. Listen,
They're gone.
Patrick. We're
They're
old.
just
Young people don't listen. We try to get young people like Lena and Taylor on, but it's just we're still old. So how much are they going to listen?
That is true.
Yeah.
That is true.
Yeah. Actually, I had to get Taylor to tell
know?
me why they say KK on the messaging. I literally, you think I'm kidding about this, but I told him.
I just thought it sounded good.
He sent me this note and he says KK, and I'm like, okay, what's with that? My kids do that to me. Taylor, why?
I don't get it.
Why do you do that? Why not just 1K?
You know what? Because I follow some kid on TikTok and he does it, and I'm like, I'm still young. I got my hair, right? Actually, I photoshopped because I don't know if you guys know, but I shaved my head. So I'm bald now. I'm bald now. That's what I'm saying. And I Photoshop all my online photos to have hair. And then I'm like, yeah, I'm 20 something, right? Right, guys? KK.
So you can do that to me? You can put hair on me?
Yeah. Yeah, we'll start a WhatsApp group called Hair Gang. Yeah. And we'll just log hair products.
That's funny.
Nice. Well, okay. On that great note, I'm going to go off. I don't know what we're having today, so I don't know what my family's ordered for me, but I'm looking forward to it.
I need to know because every week I'm like, oh, you're having McDonald's. Oh, you're having pizza. What are you having this
Burger's
week?
Priest. I don't know. The other day, I don't know if I told you, but I went up to Burger's Priest. One of the better burger places.
I haven't had a burger from there for over a year. So.
Ooh.
Yeah, you're a little strict about going out, aren't you, Lena?
Yeah, I'm.
It's called laziness.
No,
not lazy.
She's
not
COVID
lazy.
strict.
Just very cautious.
Yeah.
Extra cautious.
Do you know what's kind of strange is that I've been having business meetings walking the dog. Seriously. Very nice.
Hey, let's have a meeting while I walk my dog.
Multitasking. It's
very
great.
nice.
It's very
hedge
efficient.
fund manager friend of mine said, "Do you want to go out?" And I said, "Sure." And he said, "Do you want to go for a walk?" I said, "Sure." And I said, "Do you have a dog?" And he says, "Yeah." And I go, well, "Let's walk our dogs."
You had a play date with the dog.
It's true. The trouble is I have this 10-year-old noof, and she kind of got tired, and she's looking at us going, "How far are we going, guys? This sucks."
Until Daddy closes the deal.
Okay. On that note, I'm gonna let you guys all go.
Yeah.
Thank you for
All
tuning
right.
in, everyone.
Yeah.
Look, let's see if I win this.
Have a great weekend,
I can
everyone.
make it two in a row. I'm looking forward to Patrick having.
I can't
come up
believe
with
you screwed me over on
I
that.
know.
We'll see what other people
But
say. if
you
they
know what's
can-
hilarious is that I called it. You're so predictable.
Oh, we were making a bet on
literally
that.
I literally
Patrick.
said it to like Lena and Taylor while we were waiting for you to come on. I said he's gonna try to get me on bonds.
And we were
You
all
were
going to
so
bet on it to
predictable.
see if you were going to do it or not.
Now I have to do the opposite. I'm gonna go find some like remote market to put out on the next one.
Oh, for sure. Because you know what? If you think about it, I don't have the ability to go look it up.
Why not?
Well, I
Oh, in
do, but
advance.
like I only have a couple of minutes to try to figure it out. I've already thought this through. I shouldn't have told you anything. But anyways.
Oh, come on. You didn't know you wanted to go long bonds.
No, I was
until-
expecting a bond bet though, so I was ready.
Oh, so you were ready to go long bonds?
Yeah, because I actually think the market's headed lower, and I think there's a chance over the next week.
He knows you
But
better
you know what?
than you
But
do.
you know what? One of the reasons why I didn't want to up it is we still have an active bet from like 2-3 weeks ago about during this correction that the 10-year Treasury cracks 140 on the upside.
Oh yeah.
And so I actually am why was I going to raise the bet? Because right now I'll give you $1 and we're going to go for a burger. It's perfect. You know what? It's like it's a win for me. And so why was I going to kind of juice that up?
Yeah, I hear you.
By the way, whenever you guys cash in these bets, you guys have to take pictures.
For sure.
All right.
Well, hopefully it's just a
All
whole
right.
lot.
Anyway,
Patrick.
thanks everyone for joining us. It was
Take care.
a great time. Have a good weekend, everyone.
Bye bye.
See you guys.